Hit it. It's Friday, March 5th, 2021, episode 121. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, it's our pleasure to welcome to the show Macro Hive founder Bilal Hafeez. Bilal is a JP Morgan and Deutsche Bank FX and macro research alumni, and he's here to explain about his new service, Macro Hive, and to talk to us about what he's seen in the markets. Then it's Kuppy's Corner time, and Kuppy is trading with a new big figure. Patrick will then follow up with his usual hocus pocus, talking charts or whatever the hell he calls it.
This week in trading history, we look at the Palm IPO. We end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
So today we're drinking Amsterdam Brewing Company's Makes You Pucker Dry Hop Sour.
Ooh, I'm excited.
This one's for you, Patrick.
Just for the record, I stuck it in the freezer to make it extra cold because I found that if I'm not going to like a beer, at least it's got to be extra cold.
There you go.
Oh my goodness.
Right. Yeah, that's...
So this sour beer is brewed with lime and orange zest additions and is dry hopped. With notes of citrus, ripe mango, grapefruit, and a crisp finish, it's a refreshingly tart style.
Oh, it's like right in the teeth.
I think that's a bit of an understatement.
Actually, I think you guys should stick it in the freezer. It's not as bad that way. Like, it's actually pretty good.
Mm. Oh, I like it. It's just you can taste it. Like it comes right in at you. All right. Hey, Kev, give us a disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include yield curve canker sores, macro migraines, and then finally, Patrick, this one's for you. I chose it for you. HYG herpes. Big thanks to Ryan Voorhees 4 on the Twitter.
There you go. Okay, let's get to our first interview. All right, it's our great pleasure to have Bilal Hafeez from Macro Hive on the show. How you doing, Bilal?
I'm doing very well, thanks. Good to see you, Patrick.
So it's Kev here. Bilal, I've been looking forward to this for a long time. And let me tell you how I came about stumbling upon your great product at Macro Hive. I was listening to a podcast actually in November, and it was a podcast that you did with Yanir Baryam on COVID and the vaccine complacency and business responsibility. And one of the things that he did there was he laid out the roadmap of when we were going to have the virus behind us. And I must say that it was the best roadmap I've seen. It's been spot on. And since then, I've been an avid fan, following you, listening to your podcast. So it's with great pleasure that I welcome you to the show.
It's very, very kind of you to say that. Yeah, it's great to be on your show, and I listen to your podcast too, and I'm a big follower of your work as well. So it's a mutual admiration.
So listen, a lot of people, especially over here in North America, probably aren't as familiar with you, with your background and where you came from. Why don't we, start from the beginning? You're obviously British. Where did you grow up? How did you get into the business?
Yeah, sure, of course. Yeah, so I grew up in Oxford, in the UK. So Oxford's sort of famous for its university, and I grew up there. All my sort of I was born and raised there. My schooling life was there. But there's actually two sides to Oxford. There's kind of the university side, which is very upmarket and posh, and what you see on TV.
Right.
Then there's the other side of Oxford, which is much more run down. That's where I grew up. So my parents are immigrants from Pakistan originally, so hence my natural tan I have. So I grew up in kind of the less nice part of Oxford. But my parents, being kind of immigrants from Asia, we were raised to be very academically orientated. So I did very well at school, at high school. And I went on to study at Cambridge University. So I did economics at Cambridge. Yeah.
You had to get away from the folks.
Yeah, I had to get away from my folks. So I came up with these elaborate reasons of why economics at Cambridge was so much better than the equivalent course in Oxford. But the real reason was just to get away from my parents. And it turned out to be good because I met my wife at university. So it was a good.
Oh, that's terrific. It was a good move. In hindsight, that was the most important decision you made. Okay, so you graduate from Cambridge and you get a job in the business. Walk us through what you're doing, straight out of school.
Yeah, sure. So while I was at Cambridge, I actually did a summer internship at J.P. Morgan, obviously the well-known American bank in currency research, as it happened.
Okay.
And then they gave me a graduate offer, because I did the internship program, and this was in the late 1990s. So this was 97 was when I did the internship, and if you recall, that was during the kind of big dot-com boom. There was huge M&A deals going on all the time as well. So when they gave me a graduate offer, I actually asked them to switch it to an investment banking role. So I asked to join technology M&A rather than doing research in FX, because I thought that's kind of the glamorous role. So I started off in M&A at JP Morgan. And after 3 months, I absolutely hated it. The hours were terrible. I was working all night on weekends. The work was dull. I was effectively like a slave to my boss there. So after 3 months, I asked for a transfer back into currency research. And that's where I kind of started my kind of long research career. So I was an analyst in the currency research team at JP Morgan.
So now, was that in 98? Like your summer internship was 97, if I got the dates right?
Yeah, sure. So my summer internship was in 1997. That was during the Asia financial crisis. And then I started my proper graduate job in 98. And that was when we had the Russia devaluation and default and the LTCM crisis.
Right. So you got like trial by fire. So what was it like? You're a young kid that's, like getting thrown into this currency, just, bonfire of things happening. Talk to us a little bit about that experience.
Yeah, well, it really was a baptism of fire. At the same time, it's really quite exciting as well, kind of to see all of this volatility in markets. And at the same time, just as LTCM was kicking off, we were having the dot-com mania, which was carrying on, from 1990 to 2000. So, on the one hand, if you were on the FX and interest rate emerging market side, it looked like the world was ending. Then you spoke to people on the equity side, and it was, it was amazing times for them. So you kind of had this schizophrenic kind of dynamic. But what it did make for is a very exciting time, overall. One thing that it made me become more attuned to was, I guess, risks and downside and tail events, because if I think your early career really affects how you see things later on. And so I was always kind of attuned to, okay, there's a bubble forming here. There could be a risk here. It could be a risk there. So that was something that was quite formative for me at that time.
Right. You're like the young person that starts right in 1987 and then they forever see equity crashes. So you forever see bubbles in emerging market currencies.
Exactly. Yeah. Yeah.
Right. So you're there at JP Morgan and then you move on to Deutsche Bank. What prompted that? And did you change roles at that point?
Yeah, no, that's a good kind of question. So I was at the original JP Morgan, and then around 2001, I think it was, Chase Manhattan, which was a larger US commercial bank, took over JP Morgan. So there was a merger, a takeover. They got rebranded and kept the name JP Morgan in the end. But essentially, the original JP Morgan that I was part of was consumed by a much larger Chase Manhattan organization. So all the people I worked with were effectively kind of kicked out. And so for me, it was time to move on. And at that time, Deutsche Bank was really firing up to become this massive global powerhouse, especially in fixed income and FX. And so, they approached me. So I joined them. And for the first half of my career at Deutsche, I was on the foreign exchange research side, where I ran global foreign exchange research. And I did a lot of work on quantitative models, actually, at that time. So I actually built some of the very early, what we now call factor models or smart beta models. I built very early ones at Deutsche, carry valuation momentum at Deutsche Bank, which was really exciting. And then also I was doing kind of regular macro research there as well, just making market calls on different things. And so that was kind of my first half of my career was doing that.
Okay. So I want to jump in here, Bilal, because actually I listened to this great podcast that you gave with Michael Melvin. And Michael, I guess, is another quantitative kind of, currency guy. And he was giving you props for being the inventor of the DB, the Deutsche Bank Currency Return Index. Is this DBCR?
Yeah, DBCR, that's right. Yeah.
Right. And so this is what you just alluded to, meaning one of the first kind of models. Why don't you just I was curious when I listened to it, actually, that podcast, I'll be honest, I went back and listened to it twice because I found it so fascinating. Why don't you walk us through, how you created this model, because it was, unique at the time, why you created it, and kind of if you were to do it today, would you do it any differently?
Yeah, no, that's a great question, Kevin. Yeah, so the reason I did it back then was, every market has some kind of benchmark for investors to follow. So if you're an equity investor, you have the S&P 500 or some MSCI index that is your beta, so to speak. And if you can outperform it, then you have alpha and you get rewarded for it. In bonds, you have some kind of government bond index. In commodities, there's a commodity index. Every market has one, but FX, foreign exchange, does not. And so what happens in FX is if you make more than zero, then that's viewed as alpha. So my thinking was actually that in currencies, there are kind of well-known sources of consistent returns in FX markets. So one classic one is the FX carry trade, which is widely known and is widely done by investors, where you buy high interest rate currencies and you sell low interest rate currencies. And so you earn the interest rate differential. And over time, you find you make money from that strategy. And there's another one, valuation, that currencies become heavily overvalued. And if you buy the undervalued currencies and sell the overvalued currencies, over time, you'll make money. And the other one is trend. FX markets are trending markets for lots of different reasons. And if you buy them trending currencies, they do well. So my kind of point was that you can actually come up with a benchmark, an objective benchmark of returns for investors in FX if you capture these three sources of returns. The important thing is to make sure that these rules are widely known, because otherwise it's a private model, and all of these three strategies have been documented for decades. And then to come up with a very simple rule that is easily replicable by others. And so I came up with this sort of ranking rule where you just rank the currencies based on these different criteria, combine them together, and then you come up with a benchmark, which I call the Deutsche Bank Currency Return Index. And over time, this return index would deliver maybe 2-3% a year, with a Sharpe ratio of 0.5, 0.6, with similar Sharpe ratio to equities. And my point there was that that's actually the benchmark for currency markets. And so when you assess a currency manager, you have to compare it not to zero, but to this benchmark. Because otherwise, you can just buy an ETF on this benchmark and just do that.
I'm sorry to interrupt. I actually want to just delve into one part of it that I don't understand, not being a currency expert. I can get the carry trade. I can understand the momentum. In terms of the valuation, how do you value, I'm assuming you're saying this on somewhat fundamental basis or something of that nature. Is it a purchasing power parity kind of valuation? What is the value metric, that middle one?
Yeah, no, that's a good question. Yeah. There are different ways of valuing currencies, even on a fundamental basis. The simplest one is purchasing power parity. And in essence, it's based on the law of one price, which is kind of an arbitrage idea that the same good should cost the same between countries once you make the adjustment for the currency. So if there's a big price differential of the same good between countries, then somebody could just buy it, with the currency, converted in one country and sell it for a higher price, converting the currency in the other country. And what you find is that when currencies tend to become, say, about 20% over or undervalued on a PPP basis, that's the level where currencies start to go back towards their fair value. So, if it's 5% overvalued or 10%, it's not such a big deal. But when it gets to about 20%, that's a point where people start to kick in and try to, in essence, arbitrage, the price differential. And that's where value kicks in.
Right. And is that on your DBCR index? Is that what you use, the PPP?
Yeah. So what I did was for the PPP value, we use the OECD publishes values for PPP.
Right, okay.
I had my own models, but I wanted to use a public source.
Oh, I see, okay.
So the OECD has been publishing PPP values for decades. Again, this goes back to the point that for a benchmark, you have to use things that would have been known to people at that time. If you look back, in 1985, people would have had to, have known those values. And so I tried to make it as transparent and open as possible. So hence I use the OECD PPP value. And then the other ones were more simple. You just use market prices for the other ones.
Right. So now the last part of my question, if you could do it again today, would you change anything or is it perfect?
No, I would keep it the same, to be honest. I mean, there are ways of outperforming this model, but then for me that's really alpha.
Right.
You know, the idea back then was it really should be a benchmark. It's the same. It's almost like asking if you could should you change the S&P 500 rules. Now, of course, you could say, okay, maybe you should do equally weighted or growth or value, but for me, you're starting to go into more alpha or smart beta. The
Fair
actual
enough.
construction of the S&P hasn't changed, you know,
Right.
and the same idea with this FX benchmark as well.
No, so that's a great point. So why don't we talk a little bit more about foreign exchange trading? And I guess a lot of people just have this view of people slinging it around and in this like whole other world of trying to add alpha. Why don't I think it's probably a little relatively less known. You know, like everyone knows the S&P, everyone knows the VIX. A lot of people might know the move, but it almost sounds like your DB currency return index is the equivalent of all of those for currencies, yet most people probably, or at least like most people I know, don't know it. So why don't you talk to us just a little bit about that whole kind of infrastructure and clients and who's doing it, and why don't you walk us through how this world exists?
Yeah, sure. Happy to do that. Yeah. Well, I mean, there's lots of different players in the FX market, you know, so if I kind of run through some of the major players, you know, one would be your traditional asset manager. So the asset manager would have a bond portfolio and they would have an equity portfolio. Now, with the bond portfolio, if it's international, they suddenly have this currency exposure. And what you tend to find is most bond managers make almost half or if not more of their returns from currency bets rather than bond bets, because FX moves tend to be bigger than bond moves. So what you tend to find is many of the biggest currency investors tend to be bond managers. You know, so you have a US-based asset manager who has a global bond index. You know, they're buying bunds and Italian bonds and JGBs. So they then have a yen or euro exposure. So they're making bets on the euro or the yen against the dollar. So you have those players. And I'll talk a bit about how they do this in a moment. Then you have kind of the macro hedge funds, like the traditional ones like George Soros or Paul Tudor Jones, who kind of make big bets. They kind of say, okay, the dollar is going to go up 20%, so I'm going to buy the dollar or sell the dollar if the dollar is going to go down. But then within the hedge fund community, because FX markets are the most liquid in the world, so daily volumes in FX are like $3-4 trillion a day, it's much, much bigger than equities or bonds. You know, so for example, when I was working at Deutsche, if somebody had an order of, say, $100 million or $500 million for euro dollar, you could clear that within a few minutes. It wasn't such a big deal. Right. Whereas equities, it would take an age for you to clear that. You know, FX markets are very liquid, so it lends itself very well to quant funds. So there's a huge amount of quant funds who range from funds that, you know, you could call CTA type funds who have some kind of moving average crossover models where they get signals every day and buy, sell currencies, all the way to more advanced, you know, algorithmic type guys like Renaissance Technologies who have very advanced intraday models where they're using statistical models or machine learning models to buy, sell currencies because it's very liquid. So you have those guys. Then you have the reserve managers. So the central banks like the Chinese or the Koreans or the Japanese who have very large currency intervention programs. And then when they accumulate the FX reserves, they then have to manage those portfolios and they buy or sell currencies accordingly. Then you have the whole realm of corporates who hedge using currencies. And so within all of that, and then you have retail traders who are basically like day trading FX, you know, like the Reddit crowd, you know, would be more in that sort of area. And so you kind of have the retail guys who are just looking at charts and saying, okay, if this level is broken, then you buy the currency, and they just use lots of charts. You have the model guys who are building models from moving averages to machine learning models. Then you have the asset manager guys who are more fundamental. And so they would take a view, they'd look at current account trends, what's the Fed going to do against the ECB, and then make a bet on the currency. So it's a bit more based in economics.
Okay. Actually, I have a quick question for you about the asset manager guys. And I always see people telling me that, you know, if you go and a Japanese investor buys, or the other way around, a U.S. investor buys, you know, JGBs and then hedges it, they'll earn, a positive rate. And it has to do with the swaps back and forth. But one of the things that always kind of struck me about that equation was, correct me if I'm wrong, they buy, let's say, a 10-year JGB. They're not hedging all 10 years of the exposure and neutralizing all the parts. They're just hedging the next little while and looking at what the yield pickup is. Am I correct in that analysis? Because it's always kind of struck me is that shouldn't that be arbed away and it all be equal? And there's got to be someone taking risk somewhere there.
No, that's kind of a good question. There's different types of trades that people do in that regard. So one is, a U.S. investor buys Japanese bonds and does a 3-month currency hedge. Yeah. And so they're still exposed to the duration of that JGB.
Right.
So they're not, and they have to keep rolling the forward every 3 months. So it's not they're not fully hedging it. So there is a kind of a risk that they're taking there.
That's right.
But there's another thing which people do.
Sorry, I don't mean to step all over you. So there's a duration mismatch on that because they're rolling something, a 3-month currency, and there's 2 embedded rates there, and they're 3 months, but they're yet taking 10-year risk on JGBs.
Yeah. So what they've done is they've neutralized the currency risk. Right. So, by being long the JGB, they're long yen, but they enter a 3-month currency hedge. So that means for the next 3 months, if dollar yen moves, they won't, have a risk there, but they're still exposed to the duration risk. And then 3 months later, they can roll it again. Now there's a cost to that hedge, because you have to pay the carry on the hedge. So what they're doing there is that they would have to buy a dollar yen forward, so they'd have to pay the carry on that. So there's a cost of that hedge. So there's no free lunch here. So they're paying something to hedge to remove that currency risk. So
I have a question. I'm sorry because we're on a little bit of a lag, so I keep stepping all over you. Sorry about that. So I have a question in terms of when those asset managers are looking at things, do they really go and compare U.S. Treasuries against JGBs and are making slight changes upon that? Like that's what it kind of gets implied to me is that people will switch between these, risk-free, sovereign nations as soon as one becomes, a little bit more than the others. And I'm wondering in the real world, is that what's occurring?
Yeah, I would say generally yes, but it's not necessarily day to day. It's more like on a week to week or month to month basis. But these asset managers are very closely looking at different yields of all the major bond markets, currency hedged. Now, what they might also do is they may take a view on the currency and say, okay, I won't put a currency hedge on, or I'll put a 50% currency hedge on. And that they can adjust more frequently because it's a bit easier to adjust currency hedges because it's very liquid, whereas adjusting cash bond positions is much harder. So they do tend to be quite active.
Okay. So now one of the things that you mentioned is those traders that are using momentum, looking for breakouts and things like that. And in your podcast with Michael Melvin, he argued that momentum was the result of unobserved variables. I thought that was very smart, but I kind of wonder though sometimes if it's really more the result of George Soros's reflexivity. It's going up because it's going up. I was wondering where you stand between those kind of two, opposing views.
Yeah, I mean, I think it's a good question. I mean, in reality, no one really knows exactly why momentum works. So I think one explanation is kind of leaning a bit more towards what Michael Melvin was saying, which is that there's lots of flows in a market like FX, and that we don't know from observable data that may not even react to macro data at the same speed. So, for example, if a data point comes out, fast money hedge funds may react today, but then reserve manager may take a month to react to that, and so that implicitly builds in some kind of momentum, within the system. And then the other point is that if you look at all these different macro factors and you say, okay, based on these macro factors, I think the currency should move 1%, but in reality it moved 2%, then that extra 1% reveals that there's something else going on. And so you should probably and that is likely to be a positive factor. So you should probably follow that. So that's kind of the logic, but it's quite hard to actually prove any of these points.
And so, where do you stand in terms of watching it in real life? Like, there must be times that you've seen the reflexivity in action, in that it's just, people chasing. Are foreign exchange markets maybe less prone than equities to that reflexivity, or are they equally?
I think they're equally prone to that. You have numerous instances where you have these big overshoots in markets which go, way beyond what you would think. And, in hindsight, you come up with explanations, but it does seem like there's some kind of Soros-style reflexivity that occurs. And where I stand on it in the end is that, it's very hard to understand markets, to be honest. I mean, no matter how long you've been in it. And so, in that sense, you have to be quite humble and just kind of accept there's some things you don't fully understand, and you kind of just have to kind of go with it, or not necessarily be too dogmatic to say, I will ignore momentum and price because it doesn't sound smart, and only look at fundamentals. So you kind of need to keep a foot on both sides.
Fair enough. That's true. That's a true point. One of the things that I love about your analysis and your guests that you have on your podcast is this kind of a little more academic flavor than a lot of other, typical macro thinkers, or at least the macro thinkers that are in the FinTwit community. And one of, after listening to Michael Melvin and your discussion, I realized there's a lot of great papers out there. There's a lot of people putting out edges and like showing you things that as an investor you can come up with an edge. I was wondering if you could walk us through your how you go about staying up to date on those things, and how you use academic papers in your investing career.
No, that's a very good question. And I do find that academia has some amazing research out there. And I think it's like a untapped treasure almost. And, I'm kind of academically minded in the sense that, I'm very research orientated because I'm a researcher by background. So I'm always kind of hungry to read and find, what people are doing. But what I find interesting about academia is that they work on problems, but they present it in a way that isn't very useful to investors. Right. So they're writing the academic paper for academics, which means using flowery language, lots of equations, and trying to prove points that are irrelevant to people in markets, but are more useful for journal editors. Right. So there's an element of kind of understanding kind of the language they speak and translating it in your head to something that'll be relevant for investors. And that's where you get all these hidden treasures within academia. So the way I kind of look at this is there's all these smart academics all over the world studying, lots of different aspects of financial markets. And why not use their intelligence? And the way over the years I've got exposed to it is, one is I did some teaching. I was an honorary visiting professor at Cass Business School for a while. So I had, which allowed me to build up a network of academics, at Oxford, Cambridge, LSE, and so on, and Harvard, and so on. But then what I've done, since then is that I basically use Feedly, which is an RSS feeder, and I link it to a bunch of academic journals. So every day I check, and all the latest papers get published, and I look for titles which look interesting. Okay. And then I shortlist the ones that I think are most interesting. Then I just read them. And if the paper, has some back testing, then I kind of value that more highly than if a paper is just purely theoretical. Okay. So what I like is, for example, if a paper says, look, I'll give you an example. So I think about a year and a half, maybe a year ago, the Fed published a paper on how to look at Chinese growth using the data of other countries. So rather than relying on Chinese data, look at US exports to China, Australian exports to China, and then derive from that what is true Chinese growth. So I thought that was a really good paper. So I looked at the paper, looked at how they tested it, then I replicated it myself and enhanced it in my own way. And now we have it as a model that we track. So that's kind of an example of something.
That's fascinating. Why don't we just talk about that? What is that model showing right now? Is is China, running away in terms of growth? Or have you started to, there's been some people that are talking about a Chinese credit impulse that's going to be waning and it will actually be rolling over here? What is it showing?
Yeah, I mean, right now, as it happened, it's actually still showing a very strong growth signal. So instinctively, I kind of want to generally be bearish on China, but and that's why it's useful to have these sorts of things. And right now, it's giving a very strong signal that Chinese growth is robust, it's strong, and it's not rolling over.
Okay, so let's start talking about the markets and what we're seeing now. I think it's fascinating because the last week we've seen the market pulling ahead a lot of rate hikes, meaning that they're actually almost, it used to be that they used to bully, the markets used to bully the Fed into lowering rates. It almost seems like the market is trying to bully the Fed into raising rates, which is completely different than what Powell is saying. Why don't you walk us through what you think has happened in the last week or two and what the dynamic and how this might play out?
Yeah. I mean, there's lots of different ways you can look at what's happened over the past week or two, going from the microstructure of markets to kind of more macro. And I think for me, the micro side of it, in terms of auction failures and things going on with the Fed balance sheet, I think are less important, because I think day to day they're important, but it loses sight of something larger, which is that what the market is kind of telling you is that growth is very strong, or is expected to be very strong. And that's what equities markets have been telling you for a while, since, for the last 6-7 months, that, we're going to have a very strong recovery, that when the vaccines kick in and we have a reopening, we're going to have very high sequential GDP growth in the US. Consensus forecast, I think, is looking for like 4 or 5% growth in the US for this year and next year, which will be the highest sequential growth since the late 1990s. Now, although obviously we haven't completely closed the output gap, it's still, the market focuses on growth rather than levels. And so markets are telling you that. And what rates markets are doing now is basically saying, look, if that's the case, then yields should be much, much higher. But not only nominal yields, but real yields should be higher. It makes no sense for real yields to be so negative if we're going to have, very large sort of growth. So what the market's trying to do is it's basically trying to say that, immediately after COVID, rates markets were saying this COVID pandemic is really bad, and structurally, it's going to lead to structurally weak growth in the US. And what's happened over the last month or so, and it's accelerated over the last week, is that markets are saying, actually, COVID isn't really going to leave a permanent scar on the economy. So real rates have to kind of go back to where they were before COVID at the very least, which then forces the market to start to price those hikes sooner than what the Fed's saying. Now, the Fed, meanwhile, is saying, actually, we're not going to hike for years to come. We've got this inflation overshoot mandate. It's too early to do all of that. But the market is kind of second-guessing all of that.
Right. And so now I think that your explanation about real yields having to be higher because there's more growth is terrific. Like you articulated it beautifully. And now that they're pulling it higher, we're seeing the Fed trying to push back against it and say, no, we're not going to raise rates. Do you think we could actually get a situation where they keep pushing real rates up high enough that it actually bleeds into other asset classes and causes, a dislocation in like equities, for example?
Yeah, no, I mean, for me, I think that real rates will continue to go up and the Fed will struggle to, pull them lower. And what I find interesting is if you look back over the last 10, 15 years, so since the financial crisis, so over the kind of the QE period, during the taper tantrum, that's kind of what happened. We had the taper tantrum, which was basically the market reacted to what Bernanke said and thought, okay, we're going to suddenly have these hiking cycles. So the market started to price Fed hikes in the following year or two.
Right. That
was back in 2013. And it wasn't until the end of 2015 that the Fed actually started to hike. And the same thing happened in 2009, 2010. We came out of the global financial crisis. Then the economy started to recover. Stocks recovered. Everyone got worried about inflation. The market got worried about inflation because oil prices were going up. So the market constantly priced Fed hikes for the next couple of years. And the Fed didn't hike in the end.
Right.
But I think something similar will happen now. The market will constantly try to price hikes, but the Fed won't actually do anything. But even so, you're still going to see the market, trying to do this. Now, if the Fed is bold, they could really crush these expectations. But the way the Fed's reacted recently, it's not clear that they want to be too aggressive on that side. So the question is, if real yields, if the Fed isn't able to bring the short-term real yields down and they continue to rise, not, across the curve, but including the front end of the curve. So i.e. the market starts to price more Fed hikes. Will that derail the stock market? And my answer to that is no, mainly because you have to look at the reason why all of this is happening. The reason this is all happening is that growth is expected to be very, very strong. And I kind of agree. I think when you reopen the economy with all the fiscal spending that's going on as well, we are going to see very strong growth impulse, at least for the next 3 to 6 months. There could come a point where towards the second half of this year, where things could get more dicey, in the sense that then the growth momentum will start to slow down. And if then real yields are still rising, then you have more of a challenge to the stock market.
Okay, well, one of the things that we're talking about is a lot of fiscal. And obviously there's been a change in attitude versus the great financial crisis, where you had a little bit of, cash for clunkers and a little bit of tax cuts. But let's face it, they tried to fix everything with monetary means back then. 2020 comes along and they've learned their lesson and they've actually done more fiscal. Do you think that this is a flash in the pan, just a COVID type response, and that the moment that the world returns to normal, we're going to go back to a more of a monetary dominance kind of thing? Or do you think that fiscal is here to stay?
Yeah, no, that's a good question. I mean, I do think that fiscal is here to stay, but not necessarily at the scale that we've been seeing recently. So I think many people think that, because we've just had this recently announced almost $2 trillion fiscal deal, we're going to see these all the time. I don't think the scale will be as large, but I do think that the rise of populism, that we've seen over the last 4 or 5 years, President Trump in the US, we had the Brexit things in the UK. There's been a greater acceptance that fiscal is the way forward rather than just austerity. So I think this move towards more fiscal isn't necessarily just COVID. It was building up before then. And this was in response partly to the austerity that we saw in earlier years, where there was a greater sense that austerity had gone too far. And also there's a much bigger awareness today on income distribution issues, income inequality, so that monetary policy is not very good at dealing with income inequality. If anything, it makes it worse. Whereas fiscal is better suited to dealing with that directly.
So given that you believe that fiscal is a new reality, and yes, it'll be toned down in the coming years, but on the whole, we're not going to go back to trying to fix everything with lower and lower interest rates, do you foresee a secular rise in inflation?
Yeah, no, that's, again, an excellent question. I actually have a bit of a contrarian view here, where I don't think we have secular inflation environment. Most macro people today, whether it's kind of establishment macro people or the FinTwit world, everyone's looking for inflation and persistent inflation and so on. My view is no. And the reason I say no is that the argument is that, we're going to see lots of fiscal, not only just in the US, but around the world. We've had lots of printing of money. And so as a result, we're going to see, inflation break out. Now, the things people have said are fiscal and monetary, which is happening around the world. So that implies to me that this should be a global phenomenon. It can't just be in the US.
Okay.
And then you look at, are we going to see inflation in Japan? No. China, probably not. If inflation's falling, if anything there. Europe, no, not really. So we're really talking about inflation in the US. So we're talking about a US specific issue. Is there something about the US specifically that will generate inflation? So my kind of comment, first of all, to people who are in the inflation camp is, if you really believe that, the real trade is to then say Japan will have inflation or Eurozone will have inflation. That's the big swing is there, because they've been in disinflation for a long time. And so if you want to make that bet, then make those bets there. Now, more specifically, if we take the US, now the US has had more aggressive fiscal, so that should, spill over to the economy and could generate inflation. But my point there is that we have to understand the kind of the drivers of inflation. And in the US, the larger part of the economy is the service sector of the economy. And COVID has directly hit the service side of the economy. And over the COVID lockdown period, we've seen huge productivity improvements and technological adoption in the service sector. So suddenly all sorts of things that were in the real world went digital and have been automated in ways that you didn't expect. As an example, as an anecdote, almost all kind of primary, healthcare for non-COVID cases has been done remotely. So, for example, my son was sick, a couple of weeks ago. It was a phone call he had or a video call. He didn't have to go into the surgery anymore. And that's happening with any non-COVID related issue. And these are huge changes that you're seeing. And the reason I mention health is that if you look at the composition of inflation, say in the US or any rich country, the biggest sources of inflation are on the service sector side, and it's housing costs, it is health, and it's education. So for me, the balance here is on the one side you have fiscal monetary, which potentially could be inflationary, but on the other hand, you've had this shock to the service sector. You've had this technological adoption on the service sector, which will drive down service sector inflation, which has ironically been the only source of inflation you've had in rich countries, because manufacturing or goods inflation has collapsed to zero because of China. Right. So now suddenly all of these forces that have hit manufacturing are going to hit the service sector, which is going to drive down on a secular basis service sector inflation, which will then keep it quite low.
Okay, so given that, there's a lot of people that have been talking about the death of the 60-40 portfolio, the fact that, bonds and stocks, so they used to be negatively correlated, they might no longer be. Are you then, do you still believe that bonds and stocks will be negatively correlated and that bonds deserve a place in many people's portfolios?
Yeah, I think that one, just because of the size of the markets, I think it'll be hard to put all your bonds into other markets. So I think there is a place for bonds in a portfolio. And I do think it does provide somewhat of a hedge. There is still, notwithstanding my view on inflation, there still is an issue of the level of yields are so low and are negative in many cases as well. So what that means is, from a valuation perspective or just a lifetime value of holding that bond, you'll just earn nothing. And right. that's a very valid reason not to hold so many bonds. And so I do think that on a structural basis, you need to allocate less to bonds as a result of that. Now, what do you replace that with? It'll have to be things like credit or equities or just other asset classes. But that means that to earn those higher returns, you have to expose yourself to more risk. There's no free lunch here.
And so when you're looking at the market, I got a good sense of what you're seeing out there. What are trades or areas of opportunities do you think like that the market's getting wrong that you find especially attractive here?
Yeah, I think my main kind of point is that when you have these big sort of turns in markets, like we had the COVID crash last year, and markets have started to move up. I think the biggest mistake people can make is to try to be too clever about timing things. Okay. So my thing is just, have your core trades on and just hold them, and if there's pullbacks in markets, just kind of have faith in your trades and stick with them. So my view, as I've kind of articulated, is I'm very constructive on the world, which basically means you should be long equities. Now, which equities, you can kind of slice and dice it how you want. But for me, just, pick a selection of, markets. So in my case, I like, the Nikkei, DAX, and the S&P, just simple selection. You could pick others, and that's fine as well. I think that commodity prices will go up. So I like to, be long oil, for example, and maybe base metals as well. I think yields are going to continue to go up. So I like to be short rates. And then on the FX side, I think as a core view, I do think the dollar will go down over time. But right now is not necessarily the best time, because US yields are going up. But structurally, I would like to be short dollars and buy the Chinese renminbi, for example, which I think is probably the most attractive play against the dollar, because China has higher yields. There's a big current account differential between China and the US. And also, I think the euro to some extent, although at the moment I think it won't necessarily do so well. I think the pound is going to do very well, and that's mainly based on how aggressive the vaccine rollout has been in the UK. And there's a structural underweight of the pound globally because everybody has been so fearful of Brexit and its fallout that people just haven't been buying UK, whether it's a pound or UK equities. And I think the UK is really well positioned right now. 30% of the country has been vaccinated. It's more than any other big country in the world. I've been vaccinated, 2 weeks ago. It's even, come down to sort of lower risk groups as well now. Whereas when I speak to people in Germany or even the US, US is doing relatively well also, but Canada or France, the vaccine rollout has been really, really slow.
Right. So there's some great ideas in there. I got to ask you about Europe. You mentioned Great Britain as a great place to go, but Europe has been disappointing lately in terms of this fiscal. It seems to be that they're always promising, very few delivering. Why don't you walk us through kind of your big picture, kind of secular view about Europe?
Yeah, I think that the European Recovery Fund that we saw put in place last year was very important for Europe. That was the first time really you've had some recognition that the countries could come together and share the risk of a commonly issued bond. So I think that's an important threshold that Europe has passed. At the same time, the way Europe works is it's a very sort of institution-led approach. It doesn't like to do things on the fly. And so it takes years then for the framework to be put down and all of these sorts of things. But it does tell me on a 5 to 10 year basis, we will see some kind of Euro bond, which I think is very positive for the Eurozone. So I think that's something that is positive. I think another thing that is potentially positive is that the Germans appear to be much more open to some kind of fiscal stimulus. And we do have German elections later this year. And that's a very important swing variable. So structurally, I think there's some big positives for the Eurozone. In the short term, cyclically, things are not so good because we don't have any new fiscal, right now. The vaccine rollout has been quite poor. So that in the short term, I think there are some issues. The larger issue, I think, that Eurozone is probably on the forefront of is the whole climate change initiatives. So I think Europe is very keen on pushing the climate change agenda. So I think there will be lots of financing available for anything linked to climate change. So the European Recovery Fund, lots of the funds are earmarked for climate change linked projects, renewables, electric vehicles, and those sorts of things. Also, the ECB, I think, is much more open to green bonds and such things, so they may potentially enter that market more aggressively. So I think in terms of investments, I think Europe is really going to drive the whole renewable, green, climate change theme.
So are you looking to buy Europe like in the coming months and quarters? Because on a long-term macro basis, you kind of look 5 years and you say this is probably going to be higher. And if so, how are you expressing that view?
Yeah, I would say on an equity basis, I would buy Europe. I think valuations are relatively attractive. I think that what you're seeing, especially in places like Germany, I think you're seeing some, quite serious advances in things like the auto sector, in terms of moving to electric cars and the whole kind of smart manufacturing side of things. So what you're seeing, and this is kind of accelerated by the pandemic, is a much greater move towards trying to onshore manufacturing, and in order to make it cost effective, it has to be highly automated and smart, because labor costs are so high. And I think Germany's doing quite well on that side. So I think there's some important things that we're seeing there. So I would like to be long European equities. In general, I would lean structurally towards Germany because I think Germany is the powerhouse of Europe. Cyclically, though, I think that as the European economy reopens, then the peripheral markets like Spain and Italy will do very well because they're highly geared towards the vaccine reopening theme. So there's kind of a short-term, long-term sort of dynamic there.
So, Bilal, we're now at the stage where we're going to have to unfortunately say goodbye. But before we do, I'm going to hit you with some questions. We're going to go with favorite investment books.
Yeah, no, that's a really good question. I'm a massive reader of books, and so over the years I've read really sort of good books. But on the investment side, I would say the things that have influenced me would be number one, Warren Buffett's shareholder letters. While it's not a book, I think there's so much wisdom within that. There was actually a book called, I think it was called Warren Buffett's Letters. It was called Ground Rules, which was his letters he wrote when he first set up his investment fund in the 50s or the 60s. And it kind of collects all of those early letters, which I think is very, very good. I find, especially in my early career, I did really enjoy Nassim Taleb's books, especially Fooled by Randomness, which was the book he wrote before Black Swans. And the reason I like that was he very clearly articulated why markets don't follow kind of a normal distribution, that, weird stuff happens much more often than you think, multiple standard deviation events. And he also, while he has a very kind of aggressive writing style, he made me realize that smart models and smart people aren't as smart as they think, so it's kind of ironic him kind of saying that, but that was an important one. So those are some of the investment books, but even more than that, I think what's really influenced me have been other books which talk more about human psychology. So things like like classic books like Meditations by Marcus Aurelius, the Roman Stoic philosopher king, who's featured in Gladiator, the father figure of Commodore, at the beginning. So what, he talks a lot about how to think about the world, how not to allow your thinking patterns to kind of get yourselves carried away. And I think those sorts of books like that, I think I found really, really influential, because I think half the game in markets is less about specific techniques. It's more about not getting caught up in the moment, or not allowing your human biases to kind of make you do things that you shouldn't, or not to feel too despondent when you're doing poorly, because doing poorly is just a natural part of life. And unfortunately happens too often.
I did not expect Bilal to get to the macro guy to tell me that he was one of his favorite books was Warren Buffett. That okay. was a little out of the blue for me. Yeah. So listen, we'll give you the last question will be, if you were talking to a young person that's passionate about markets and interested in getting involved, what advice would you give them?
Yeah, well, what I tell them is, just immerse yourself in finance. And I think the important thing is, to get the foundations right. So learn kind of the fundamentals of any market, whether it's equities, interest rates, FX. Learn, how valuation works. Learn, concepts like carry and dividend yield. Just kind of get the good grounding in kind of the principles of markets, because later on in your career you won't really have time to look at that. So get the grounding right, and it's easy to get caught up in Twitter and not have a process and just bounce around from one tweet to the other. So I think do your homework, learn about markets, do all the hard work of learning the minutiae, build up your technical skills, and then importantly find mentors, who can either directly teach you or remotely teach you, whether you kind of follow their writings.
All right, Bilal, before we let you go, you have a great website with Macro Hive, and I'm sure many of our listeners are very interested to learn about what you do there and what it's all about. So why don't you let all of us know sort of what it is, how you get access to it, and where people can find you.
Yeah, no, thanks. I appreciate that. Yeah, so, so after I left banking, I set up Macro Hive in the summer of 2019. And in essence, the idea there is to deliver high quality macro content for investors, all over the world, and to make it as accessible as possible. So we have a website, macrohive.com, and we charge a monthly subscription. It's not too high; it's like $30 to $40 or so, and we make it open to everyone. And on the site, what we have is we have people like myself and our team at Macro Hive, and also outsiders write short pieces on different macro topics. So, for example, this week we had a piece on why the Fed is failing. We had a piece on the energy consumption of Bitcoin, another piece on will the rise in US rates impact the housing sector. And all of this is written from, people who are seasoned researchers. But the criteria I have for people who write is that it has to be less than 1,000 words. So it's very easy and clear to read. And the other thing, if you do become a member of Macro Hive, is we have a Slack room for all members. So if you become a member, we have a Slack discussion room where people go on there and they talk markets. And the feedback we've got there is that people find it as a nice break from Twitter. So you can actually have reasonable exchanges with people. It's very civilized and it's very kind of thoughtful exchanges. So this week there's a bunch of people were talking about NFT, non-financial tokens. That's kind of a big sort of buzz things about, how to trade them, whether you should trade them or not. And that's something that's been very popular. And the other thing that we also do, which is very popular at Macro Hive, is we summarize academic papers as well. So I talked earlier about academic papers. What we do is we summarize them down to 4 or 5 minute read. We remove the jargon and just tell you the bits that are relevant for investors, and that's a very sort of popular part of it all. So I it's a great resource, I think, and I hope people enjoy it if they when they access it.
Bilal, it's Kevin here again. I can attest. I'm, a recent convert. I'm completely signed up. I love it. It's become part of my must read every morning. And you forgot to give a plug for your podcast, which I view as one of the best out there. It's Macro Hive Conversations. Make sure you check that out. So Bilal, thank you very much for your time. We really appreciate it and look forward to having you on again sometime in the future.
Great. Thank you, Kevin. It was great chatting to you.
All right, it's that time of month again for Kuppy's Corner. Kuppy, how you doing?
Doing great. How you guys been?
Oh, we're doing great, and we want to start off by wishing you a happy 40th birthday party. Or not birthday party, birthday.
Yeah, thank you. I'm kind of surprised I made it through the party.
So for our listeners that don't know, I made it down for Kuppy's 40th, and actually, I don't remember too much, Kuppy. It's I have just faint memories of things that happened.
And then what I like best, Patrick, is you might finally made good on your stake bet.
Oh, that was necessary. So
yeah, next night, right? Like the next night you went out in the Euro when he picked you off.
So many of our listeners know that that we make these bets on a weekly basis, and we haven't done a steak dinner bet between me and you since we started this new version. Right. But let's rewind over a year ago. I think it was like in January of 2020 or something like that. We made that bet on the Euro, and the two of you tag team me. It was on the 115 handle on the Euro.
Well, and, to be fair, 1 second, I didn't tag team you because I actually feel bad because Kuppy picked you off and then you stayed bid and I was like sold and I was like, why is he still bid? And I was like, okay, I'm going to hit that still, right? And I knew it was the wrong price, so I do feel a little bad. I feel like as my partner, I shouldn't have done it.
Oh, come on. It's just a stake. But I'll tell you, like it was looking good for me until COVID hit. Right, like I mean, when that Euro spiked, it first went up to like 114.95, and during that March run, and Kuppy was already bragging about it on Twitter, and he Gucci'd it for himself.
That's right.
First.
Yeah, the first it got close, like, and with his
5 ticks.
5 ticks.
Yeah.
Oh, I didn't realize it was that close.
Yeah. 114.95 it printed, and it took over 4 months later for you guys to close the deal on that close above there. It was
just goes to show you the market gods are listening.
Yeah,
that's what Kuppy was proof, living proof that they listen.
So
you get too cocky about it. So
what you do want to know though, Kev, is that Kuppy's wife really enjoyed your steak. Since you weren't willing to come down there to settle the bet, you don't get it.
Fair enough. Fair enough.
So Kuppy, she enjoyed it, right? She liked the steak.
I heard, and Patrick actually served you a bottle of wine that wasn't out of a box, so I was really proud of him.
It was good times. Well, happy birthday, bud.
Hey, thanks. Thanks for coming down to celebrate it.
Yeah.
Okay, so let's talk some markets.
Yeah.
You go ahead, Patrick. You take
No. You got it.
Okay, well, Kuppy, I know there's not a lot to talk about in terms of new ideas, or is there? Because one of the other day we were tweeting back and forth, or not tweeting, we were just talking overhead, and you said you were buying Russian rubles. And I was like, what the hell? Like, where did this come from? What's your thinking? Why are you looking at the Russian ruble?
Well, basically, when you look at all the currencies, they all kind of suck. And then the ruble, in a way, sucks less. You can go through the macro. They're an oil exporter. Oil prices up. You can go through. They've left the dollar system in a way. And then you look at them just from a strategy standpoint. If you want to have geopolitical power, you need a strong currency. I didn't move a lot of my capital into rubles, obviously, but I don't want it all in dollars.
Right. So you chose the ruble. And so what did you do?
The chart's setting up about right too. And,
so
and
how
besides,
did you?
I've drank enough vodka. I feel like I'm an expert on Russia.
So how do you actually do it? Like in terms of executing the trade, did you actually go onto your interactive brokers and translate into rubles, or did you buy an equity position? And what did you do?
Oh no, I just did the straight currency. I mean, it's got a small positive carry, and I just put it on. And I think over time it's probably going to do okay for me. I don't expect great fireworks. It's currency, and I'm not levered, but right. I needed to move some of my money out of dollars, and that's the least bad.
Yeah.
There you go. That's the great thing about interactive brokers. They let you do crazy stuff like that. It's just like, okay, I'm going to trade some. Yeah, I'm going to trade some rubles, and it's just like, okay, great. Whatever you want, we'll set you up. Okay, so what else are you seeing out there in the markets? Why don't you walk us through in terms of the SPACs? There's been some real bloodshed recently in terms of this. Do you think that this was a capitulation moment? Is it over? Is the selling over? Or is there still more pain to come?
Oh, I think it's just starting. I mean, if you look at Ponzi schemes historically, it's a very simple mathematical equation. If more money goes in than comes out, they go up. And when more money comes out than goes in, they deflate. And they tend to deflate really rapidly. And then when you look at Ponzi schemes historically, they rarely reflate. They kind of bounce around a little, and they just kind of keep deflating. And so, I would think that we're done with the SPAC bubble. I mean, it's kind of crazy when you think about it. Like Chamath SPACs were trading at 2 times cash. You don't even know what the deal is going to be, and you're like, okay, I'll pay 2 times this cash and hope it's a good deal. Now they've deflated down almost to cash. It's where they ought to trade, I guess. And then a bunch of his deals are starting to really break down.
Yeah, so let's talk a little bit about that. Are you talking about CCIV and the fact that it was trading, is that the one you were mentioning? Because
no, I'm talking about IPOE, IPOF, Clove. Space fraud, he blasted that. What did he sell? 6 million shares yesterday in a market order. He's a great stock promoter, but you can only promote. One of the mistakes I think penny stock promoters make is that one deal works, and then they do 15 simultaneously, and they spread their audience too wide. Ponzi schemes need to be very focused sort of things.
So let's just talk a little bit of IPOE. Was this one a deal that had not even been this SPAC? There was nothing he had bought. It was just rumors, and yet it had gone from $10 to $25. Am I correct?
He has so many deals. I forget which one does what. But 1 or 2 of them have no business at all. There's been nothing determined about what future fraud it's going to purchase. It's just literally. You're paying 2 times NAV for Chamath's stock promotion ability.
It's unbelievable, isn't it? And what I guess people don't understand, I know with the CCIV, this is the one where they were going to buy Lucid, and they were running the stock up before the terms of the purchase, of any purchase that might happen, were actually finalized. So as the stock went higher, it just meant that, theoretically, they would have to offer less stock. And so you were just diluting yourself before you even bought it. And I think, I'm kind of actually flabbergasted. at how inefficient and how little people understand about the whole process of SPACs. Like how they think that they've already bought the Lucid, and that by pushing up the price before they actually bought it, they've influenced the price that they're going to get it at. It kind of just boggles my mind.
It really is quite crazy. You have to remember, though, with a SPAC, the product isn't Lucid Motors. The product is all the bag holders that Churchill Capital brought into the deal. The shareholder base is the actual asset here. And if you can bring lots of bag holders, you can overpay for a company and sort of make the math work. And I think people really forget how the math of this whole thing works. And I got a feeling, if they're going to do 15, 20 of these a week, every week, eventually you're just going to run out of idiots. And I feel like they've overwhelmed the idiots. And then that doesn't even include all the unlocks. Because remember, like a SPAC might be 100, 200 million shell, and then they're going to buy a multi-billion-dollar asset. So it's not so much the 100, 200 million that will eventually be sellers. It's the billions and billions of inflated value asset where all those guys went out too. And I think they've just kind of finally overwhelmed the pool of.
I love it.
Well, you're not supposed to say that, Kuppy. And Patrick, this is not because our guest said it. This does not give you a chance to go out and say that word, Patrick.
Damn it!
Okay. Fuckwits. That's
okay. That's actually much better. So, Kuppy, one of the things that actually I would like to just kind of clarify in my mind is how the pipe works. And this is like a lot of times at the time of the announcement, they will do a pipe. Do you understand it well enough to kind of walk us through how the pipe financing works on a newly announced SPAC deal?
Yeah, absolutely. So, the promoters and the bankers go to large hedge funds. They say, we've bagged a bunch of fuckwits, sorry. Yeah. We're going to sell them some fake EV thing that doesn't exist. The stock is at 15 or 20 right now. We think we can pump it to 30 or 40. And you guys, all our drinking buddies, can buy shares at 10. And yes, you are locked up for exactly 30 days, but 30 days and a day later, you can dump as fast as you possibly can. But it puts more cash into the shell, which actually raises the fair value. So even though the shares is trading, let's say, at 20 pre-deal, by putting money in at 10, you're actually raising the value of the shares, even though it seems dilutive to raise money at 10 when the stock's trading at 20. But since the actual value is zero, it actually is somewhat accretive to everyone.
And so this is often, not only does Chamath go and do like the actual SPACs, he'll also do pipes or he'll participate in the pipes, will he not? Like I think that there's like a little bit of incestuous relationship on some of the times in terms of the people doing the pipes.
Oh, absolutely. It's all, buddy deals where, it's basically free money because you can short these things out, even though you're not supposed to. Everyone does it. And, it's 30 days you can flip. So it's hard to get into these deals. And, Chamath's doing other guys' deals. Other guys are doing his deals. It's all just kind of a fleecing of the public. But then at the same time, if it's a Chamath deal and he doesn't put some of his own money up at the $10 pipe, it might not close the deal. So it's kind of like a, good housekeeping seal of approval that he's at least risking some of his money for 30 days.
Okay. And so now you're convinced, though, that the bloom is off the rose and this thing's not going to come back to life, that we have seen the top in this speculative fervor in terms of this sector or this vehicle, at least.
I think so. I mean, as you've always said, it's kind of like this rolling series of bubbles. Yeah. And so like the SPAC ones are kind of done. Now we'll go find some other insane bubble to go chase.
So any ideas of what those might be?
Dogecoin or Dogcoin. I don't even pronounce
Dogecoin, I believe is how you say it. Dogecoin.
Is that how Canadians say it, or that's like actually how you say it?
I don't know. I think that's actually how you say it. I could be wrong, but as many of our listeners will point out, I am no crypto expert.
So let's talk about crypto real fast, because this has been kind of a fun. No, the bits in the sky are crashing. I thought you guys all had me this weekend. It got down to 43, and then the pump must go on. They primed the pumps. I don't know what the right but they just pumped it away. Michael Saylor, he's been twice this week. He's put a stinker bid in, been hit, but he's been able to kind of tweet it higher. I genuinely think this is going higher. It's a world-class Ponzi scheme, and I just don't think a Ponzi scheme of this magnitude is just going to deflate on a Sunday. I don't mean that like funny. I mean that like truthfully. I think this is one that it'll go to some insanity level. That's not just like the price of Bitcoin, but just in terms of the world wraps its mind around this stupid asset. It'll alter the world, probably for the worse. But it's just not going to end like with a whimper on a Sunday.
Send all your hate mail to Kuppy at
Adventures in Capitalism.
That's right. Okay, so let's go on to the next topic. What else have you got? What else are you trading? What else are you looking at? Anything else catch your eye?
So have we talked about Cornerstone yet on this?
No, let's do it. Actually, there's a good name, and just in full disclosure, I am actually long as well. Like this is one of them. It's a real company that does. Well, why don't you tell us what it does? But to me, it seems like it's a little more stable versus some of the more speculative names that you've been involved with in the past.
What? Bitcoin's not speculative. So Cornerstone, they're leaders in various verticals to the housing supply chain. So they do, stone facade, and they do vinyl windows, and they do aluminum siding, and a bunch of things that go into mostly lower end homes. And as we know, the demand for homes right now is in the lower end as people leave cities. And they're just booming. I mean, their biggest problem is that they can't produce the stuff fast enough. I like macro trends. I bought a bunch of it last year, about $5, and I actually added a ton before the Q4 earnings last week at 11, and today we're at about 12.5. I don't know. I think I'm paying about 3 to 4 times next year's cash flow, and that seems pretty cheap for what I think will be a multi-year, cyclical sort of thing, almost secular, really. If out 5 years, almost secular in my mind. And I think they're going to delever quite a lot. And when they take the debt down below 4 turns, I think it's going to re-rate much higher at about 15 times.
I think that the other thing that's happened, Kuppy, is that this backup in yields has definitely affected a lot of the housing type names. And speaking of affecting the housing type names, we see that this backup in yield has caused Joe to have to take a little pause. Are you using this opportunity to add to your position?
Yeah, I've actually added a few more. I mean, I have a pretty full position, but I had some inflows in my fund, so we're gonna, buy it on the downtick. And I even wrote some of the 45 April puts because I don't mind owning it at 43 or 42, wherever I'm assigned net. I think people are looking at housing and they're saying, the long end's ticked up, 50 bips on a mortgage, and everyone's in panic, and people aren't realizing that 50 bips is kind of a rounding error in the scheme of life. And if you want to move like 50 bips, you're talking about like a couple $100 a month. Like, who cares?
Yeah, I'm actually shocked at the excitement that it's getting. Like, go pull a 30-year bond kind of yield and look at it over the last 4 decades. And you can barely see the move up that we've had recently. Yes, it's been a lot in terms of from the COVID lows, but those COVID lows were crazy low. Like, what are we here? I'm looking right now. We're 228 on the 30-year. Okay, you know where it was in 2018? It was above 3. So we're still 75 basis points below that.
Right. It's genuinely cost effective to go buy a home, and then I think a lot of people, they won't put it in such elegant terms, but let's say inflation next year is, 7%, and you're going to finance at home at 3. So you're going to have, 400 bips positive carry on levered 5 times, you got to put 20% down. Like, you levered 5 times on an asset with 400 bips positive carry. I mean, that's a recipe for homeowners to just build equity for the rest of their lives for 30 years. Like, I think a lot of people are going to overpay and pay up to get a little bit more home than they probably can afford or want because the math is so attractive.
The other thing is that I really believe that American homes are some of the cheapest relative values out there. And I'm not talking about the 1% gateway kind of markets like the Miamis, the LAs, San Franciscos, New Yorks. I'm talking about the other things that didn't participate in much. What happened was that after the great, financial crisis and all these people saw their parents getting destroyed, all these millennials, they refused to buy houses. So when you look at like American millennials, they're way underhoused versus like here in Canada, every single millennial we know stuffed to the gills with them. They own condos. They own no, honestly, it's like a full-time. That's all they do. it's even the next generation are going to start buying them soon, because here it's like a religion in Canada. We think it's always going up. But so I look at the U.S. housing and I look at it and yes, it might feel like it's gone a long way. But when you look at it over the global basis, look at it with a little bit like stepping back, and you look at the non-gateway cities, they're dirt cheap. And I think they could get a lot more expensive.
I think so too. And then, what happened is for about 20 years, you had a big population flow from basically flyover country to the gateway cities. And now that's reversing a bit. And just a bit of reverse can do a lot to pricing because it's all priced in the margin. But then population's also grown. And that's why, companies like Cornerstone literally can't produce product as fast as its demand. I mean, their backlog's exploding. Or you look at Joe, where the number of lots they're selling is just going parabolic. I think these are both great stocks to own for a very long time. My biggest sector exposure actually is housing and housing supply chain in the United States. I own a few of these companies, and I tend to think that it's going to be a great multi-year sector. In the end, the millennial generation, they kind of put off having kids for like 5 to 10 years. Beyond what the demographics says they should have done, and so now they have this catch up, and they're all rushing to buy homes and fill them with kids, and I don't think that's going to change.
Right. All right. Well, Kuppy, listen, I know that you have some plans here, so we're not going to hold you too much longer. But listen, you have this Kedem report that you send out, and there's been some great picks in there, like the recent move in Groupon was another example of some really neat things that are coming out of there. Why don't you quickly let all our listeners know a little bit about that and where they can sign up?
So I started, a service to track event-driven strategies. We've been flagging things. I'm surprised actually how many of these we flagged and how many of them actually move. It's exceeded my expectations. I wish I'd done this 5 years ago and I made a lot more money on my own book. You can go to kedm.com to see what we're following. We send out alerts every Saturday. We're mainly tracking corporate events and fund flow events. And, like I said, we've been doing surprisingly well at finding these things and also flagging the ones that are going to move. And I think the reason for that is just that passive is kind of taking over from active, and which means that these things overshoot a lot more than they used to. And then, Robinhood's added all this retail that also forces things to overshoot. It just creates a lot more event-driven opportunity. I mean, look at today. The market's traded in like a 4 or 5% range in the Nasdaq. Like, that's kind of crazy when you think about it. Yeah. And these sort of things are just happening in smaller caps to a bigger scale.
Right.
Yeah, no, I completely agree. And actually, I would argue that indexes made it so that the things that where they used to be lots of people arbing are no longer there. So there's more opportunities for those who want to take the time and go spend a little bit of work. And I think KDDM is a great place to start. Yeah. So, Kuppy, listen, I missed you on your birthday, so hopefully we get a chance when we're finally allowed out of lockdown that I'll be able to come and share a beer with you. And
welcome to your 40s, Kuppy. Is the key?
Yes,
it only gets better. You might lose some hair, but
yeah. Well,
I'm getting fatter and balder.
Yeah.
Eventually, you'll look like me.
Yeah. Good luck.
Anyways, listen, take care. Have a great weekend, and thanks for joining us today.
Hey, sure thing. Thanks for being on.
All right, Patrick, it's time for your hocus pocus. What do you got for us with talking charts?
All right. We have to talk about the top 3 things to watch. First of all, we start off with just a quick review of what happened last week in our top 3 things. Well, first thing was the big wave of economic data. And certainly it seemed like both the jobs numbers and Powell's speech were particularly the ones that garnered an equity reaction. What did you take away from how everything developed last week?
Well, they just crushed the belly of the curve. Hey, they just crushed it. And the pain in the bond market is huge. It was driving everything. And every single, strong economic number, ended up causing more pain in the bond market, which then did coincide with eventual equity kind of pain at certain points. Now, having said that, we taped in this Friday afternoon. They seemed to shrug it off. Bond market finally seemed to put it beside it, and rally up at the end of the day. And then the stock market just went screaming. So maybe it's over, Patrick. Maybe that was the worst of it on the bond side in terms of the economic news, and maybe the worst is behind us.
Right. So number two, it was was this just a quick little market correction, or was this something bigger? But you know what, Kev? I think that I want to save that for when we start pulling up charts, because I think there's a bigger story to tell, and I'd really like to kind of take a tour of it. So let's save circling back to that one. But number one, you were just talking earlier here was, are we going to have seen the capitulation in bonds? And and certainly the selling was quite intense. And the 10-year Treasury yield, if I can just pull it up over here, really had that rip. I mean, at one point we were north of 160 on the 10-year. It really looked like, so I don't know, the capitulation isn't here yet. It seems like these yields are still continue to get pressed higher as bonds get hammered. You're talking about the belly of the curve getting a little bit of a kick there, but I don't know.
The fives are even worse. Like, well, why don't you dial the fives there? Because that was where the real pain. I saw something like in terms of standard deviations, like a sigma move. It was something like a 5 or 6 sigma move.
That one big up day?
Yeah, and it was huge. Like, it was big.
And it was almost,
you know my rule about sigma moves. Whenever there's a 5 or 6 sigma move, you should always be ready, because it never stops there. It goes to 10. Who knows, though? I kind of feel like bonds might be a little bit different, in that this might be the worst is behind us. Call me an optimist. I actually think, Patrick, even though I have been the biggest bond bear out there, from here on in, it feels like on the dark side, it's going to be a little bit tougher slug, and that you might find that, especially at the short end of the curve, it makes sense to own it.
All right. Well, let's talk about the top 3 things to watch next week. So number 3, I wanted to just talk that U.S. dollar. And I mean, we've circled back to this one, and really there's no way to put it other than that it's been in at least the index itself has been in a trade range for a better part of 3 months, right? This kind of 90-91 pocket contained like the vast majority of the price action since December. And just in the last couple of days, the U.S. dollar finally seems to be kicking out of that range, heading higher. Now, one day does not make a new trend. I mean, it could prairie dog, it could do all sorts of stuff. But this is the type of a breakout that starts getting people's attention. This is the first time in a long time that we've seen the dollar trading above its 50-day moving average, and a number of other kind of metrics that way. And I think one thing we have to watch is whether this turns into something a little bit bigger.
No, here's my question to you: can the U.S. dollar rally, and we still have things like stocks and commodities going up as well? Like, conventional wisdom is no, but I'm not sure conventional wisdom is going to be right. Especially if
I'll push back on you there. I actually think that outside of oil, the vast majority of commodities are already reflecting this dollar push. I mean, oil had its own little OPEC catalyst. But I think that really at this stage, the dollar is kind of taking the wind out of the sails. I don't know whether we're going to get nasty corrections, but I mean, if we go through some sort of a dollar impulse, particularly some sort of a proper squeezing to the upside, I think that's the conditions from which commodities will take a break.
And what about the stock market? What about other risk assets? Like, if we saw
well, I mean, look, the stock markets are already wobbly. Right. We'll talk about that in the charts in a moment. But anyway, let's talk about the dollar. Do you think there's room for a short squeeze here?
Well, I'm not as bullish as you are, probably. You seem to always love the U.S. dollar. Could it go higher? For sure. There's no doubt that a lot of the fast money was leaning short, and if you get a rally, you kind of force them to cover, and we get a little bit of a squeeze. But, I would talk about how much of a squeeze and whether it ends up being painful. Like, that's, to me, the bigger question. Yeah. And when I look at it, I say, no, I don't think the conditions are in place for a real squeeze that's going to hurt. And so, therefore, if we do get a rally, I think it's a rally you sell.
All right. Well, then number 2, we got to watch those inflation numbers coming out next week. Is there something in particular you're watching about them, Kev?
Well, no. Obviously, as we get into the periods upon which the COVID crisis had hit last year, meaning that as we get into March and onward, what we're going to see is the year-over-year effects are going to become all the larger because we had, deflationary, impulses back then. So we are going to see some, probably some headline numbers that are quite high. The real question is, does the market already understand that? And will they just look through it? I don't know the answer. And it could be as well that the market doesn't looks through it, but then everyone else freaks out about it because they don't understand that the year-over-year base effects are going to cause these things to uptick.
Well, I have to agree with that. I think that those year-over-year changes are always something that flags things, and a lot of the quants will pick up on these things. But I just don't think that is going to be truly a reflection of whether that inflation boogeyman scenario in the bigger picture is here. It's certainly going to be some bigger number prints for sure.
Yeah, so Patrick, so just so you understand, I'm completely with you there. Like I look at it, even if you get bigger numbers, that the market should understand that there really is no inflation in terms of just because it upticks because of the year-over-year effects doesn't mean you should get any more excited, meaning that inflation's going up. But having said that, it could be that actually it's a self-fulfilling prophecy, that people do see it and they go, oh, there is inflation, and therefore they're more willing to raise prices afterwards. So It shouldn't be. The market should be more efficient. It should look through, but I'm not sure it always does.
Right. And so number one, what's next for crude oil? We have to really watch that next week. And there's something particular about it, right? So yeah, you know what? OPEC came out. It really did give some huge tailwind to the acceleration. But the way that oil has now accelerated to the upside here, blowing through 65, we're now north of 66 on this April contract. We're entering some sort of almost parabolic acceleration, which rarely, most often than not, it ends in some sort of deep mean reversion after such a move. But that doesn't mean it's over. Like when you're looking at the slope of these trend lines, we're like this last move, this is almost now going hockey stick to the upside. And it doesn't mean it can't go to 70, 75 early next week. But just like what happened with copper, once something accelerates this magnitude, does it mean that some sort of like a swing high may be in store here in the month of March? And more importantly, what price level will that be from? I mean, can we make it north of 70 in this push? Do you have an interpretation? What do you think?
Well, a couple of things. First of all, Patrick, you know what? Someday when we're really old, and if you go first, I'm going to take those charts, those lines, those slopes, and I'm going to draw it at your celebration of life, because that's the one thing that I remember about you more so than anything else is you drawing those slopes. And I must say, it is very instructive, because you can see, for those that are listening, Patrick draws a slope from May to December, and it's almost horizontal. It's going up a little bit. Then he draws one from November to February, and that one's going up at a steeper angle. And then he draws one from February to March, and it's going up at a steeper angle. And it's really instructive, and it's really great in terms of visually looking at it and to understanding what's happening. And one of the things that I will agree with you is that as you get into those deeper slopes, meaning that they're the steeper slopes is probably a better way of saying it, you will find that rarely do those correct by going sideways. Yeah. And so I am with you there. Now, in terms of you forcing me to say, is this going to stop here and correct, or is it going to go to 70 or 80? I'm probably more bullish than you in terms of where it can go. So I'll take the other side, and like I think
it's not other side. I actually don't want to step in the way of something that's accelerated to this kind of magnitude. Like you can see here on this chart, this is the continuous chart that, and you could see all of these highs that came in through 2019 with the red line. We just blew through that like it didn't even matter. And the highs from 2018 on crude oil. This one high came in at was $75, and the highest point was about 77. It was 76.90, and so I mean that's still up to $10 higher. And so I'm not in any way already suggesting that this is over. But typically what will happen at this accelerated phase is we'll get to the 70, 75 level in a week. Like this, the whole point of this last phase is it creates that panic buying that creates that acceleration. And so I'm not in any way trying to already say it's over. but really, I think it's from a time frame. It's very likely some sort of a short to intermediate high comes in this month for sure. It's just where we're trying to figure out is, does it come in next week, and does it come off of what level? It really is this accelerated moment in crude.
Well, I think that's really wise. Although I think saying this month is a little bit of a like a cheap getting out of it. Because let's face it, we're at the beginning of the month. That's 4 weeks. Is the high going to come in the next 4 weeks in terms of the intermediate basis? Yes. The question is
it's likely even within the first half of the month. But you know what, the idea is that when things go parabolic like this, the time component is very small. The price is the variable, because the price we could go to 75, we could even go to 80. It can happen, but it usually happens very quickly here. And some sort of a kind of short-term blow-off along the top end happens. By the way, I wouldn't short that. Our listeners need to know, just because we think something like that, but it is a healthy exercise to take some profits and build in some hedges on your positions as you're going higher. So those that are holding it, when you're given this kind of profits this quickly, sometimes it's important to make sure you don't give it back, right?
And Patrick, the one last thing I'll leave you with is the idea that I've been saying for a while, that we're going to see $100 oil this year. And, I would laugh myself silly if it ended up being on this rally. If it accelerated to the point
I'm a seller on that. I think,
of course, you're at 70, it's $25 away, but it would make me laugh so hard if it ended up being that we hit the triple digits this month.
I think you'll see it this year, though. I'm not gonna sell you.
You goochered my trade. Okay, let's go on.
All right, let's talk charts. Okay, we were talking about the stock market earlier. I said we're going to talk about it when we get here. Okay, so first observation I want to make about the stock market is the one thing that for sure happened after the gamma pin got lifted from the thing is that volatility came back. I mean, in this post-OPEX period, 100 S&P point intraday ranges day in and day out is par for the course. Like, we have just seen the intraday volatility come back big. And really, that's the best way to define the majority of the markets, because whether you're in the Russell, whether you're in the S&P, whether you're in the Dow, that's not where the most aggressive selling has been. It's just been so choppy, and so emotional too, right? But we have with the S&P trading stone's throw away from 3850. The VIX is still at the 25 level. We did have spikes above 30 temporarily, but we haven't seen the really broad market have a freak out. But where almost all of the selling has been is in the tech. You've been talking about on the show for weeks about selling the FANGs. And that's really been where the correction has been. The NASDAQ is now corrected over 10%, which is, we were looking for, typical market corrections occur where, 10% pullback happens. We've only seen these 5% pullbacks in most of the U.S. equity markets, but not the NASDAQ. The NASDAQ's down like 11% from peak to trough. And so this is definitely where the selling is. We've already done a 50% retracement of the entire November through to February rally. And so this is where everything continues to dump. And obviously, we were talking with Kuppy about it, but everything from those SPACs to Tesla, like the MSTR, all of these things have just been getting hammered. That's a bad tick, by the way. It never traded up that way on that chart. But we saw, Tesla from top to bottom in just in a month, traded down 40% off of its highs. And that's at its peak, it was an $800+ billion cap, right? And so to wipe out 30-40% to the downside like that is quite the hammering on a few wallets out there, right?
Well, you just named all my trades, so I'm really worried about the Gucci now. But you know what? Okay. As you were saying that, Patrick, one of the things that stuck out to me is that I have been sitting around thinking about corrections in the stock market. And I had talked numerous times about the fact that if you look at the 98 to 99 period in early 2000, even though the NASDAQ went up, it doubled and then doubled again or whatever it did. It did crazy amounts. There was something like 9 corrections of 10% or more.
Yeah.
And there was tons of these in there. And I had been talking about this and saying, no, you should be expecting this. You should be expecting this. And one of the interesting things is, as you sit here and you sketch this out and we see it, I'm wondering to myself, so we saw the correction in the NASDAQ. And whereas I previously had thought this is a bigger move and that the NASDAQ leadership is no longer, the NASDAQ will no longer lead the market. I'm wondering if maybe I'm wrong. Maybe I'm maybe we're going to see this thing bounce back. Like I don't get me wrong. Like I actually don't really feel that way. But one of the things is that you were doing it. I was like, oh my God, maybe this is just one of the corrections that we can expect in that kind of 9, corrections of 10% that we're going to get before this thing blows off.
Right. I mean, listen, there's always room for liquidity events and little flash crashes and all sorts of crazy things. But to really call a bear market, it has to be a little bit, there has to be something structurally changing in the macro space for that
Patrick,
to happen.
But sorry to interrupt, but is the question I have for you is, do you think that NASDAQ's leadership is gone? And whereas before I was sure that it had, now I'm kind of like, oh, maybe it isn't. Like maybe this is just a little correction in a bigger trend.
I think a lot of that may have to do with your rates call, right? Because if we see, let's just go through a thought exercise. Okay, let's go through a thought exercise of what could happen in the markets that would screw over the maximum amount of people that have consensus trades on. Okay. Right? A dollar short squeeze, reflation trade takes it on the chin, all commodities just go through a healthy correction. Forget about like a new commodity bear market. Just like they just got way ahead of themselves, and we spend just like gold 6 months in a correction. Like we go through some sort of mean reverting correction in commodities during that kind of a period. I mean, if we see the reflation trade had the wind taken out of its sails, and some sort of like a little disinflationary impulse comes in, money will rotate back into tech, wouldn't it?
Yeah, I guess you're right. And although I'm not sure about the dollar. I know you keep thinking the dollar is very.
We were just talking about a narrative.
No. But listen. I agree with you that the commodity trade is really crowded, no doubt about it. And I would argue that the one that's the least crowded is the one that's behaving the best. To me, if you say you want to be long copper, everyone tells you, yeah, that's a great trade. If you say you want to be long oil, they're like, that's crazy. There's very little speculation on the
But I still think that that's because copper has been in a bull market much, much longer than oil. I
don't disagree, but I'm just saying that's where, in terms of sentiment, that's where the potential is, right?
Yeah. So anyway, let's move on, because what I wanted to just highlight was that really this has still been a sector rotation. There is no evidence of a broad repricing of all equity. Like the Russell is still a stone's throw from its highs. You basically go and look at something like financials, XLF, let's just use as an ETF, right along its 52-week high. You have you take let's say the value index, we'll just use the value ETF, BLUE, right along its 52-week high. We take the XLE, the cyclicals in terms of like energy plays, like you were talking about, making fresh highs. There isn't some big, broad liquidity event. This is just money rotating out of tech and chasing all of these kind of cyclicals and value, and it's just one big rotation. That momentum value factor that we showed. Like, look at this puke on the downside. Like this is really what continues to be the underpinning theme of this last 2 weeks.
Well, and so one of the things I'll tell you, Patrick, is that over the last decade, there's been an overwhelming consensus that interest rates are going lower, indexing is going to eat the world, and that you basically have to buy the large cap, high tech growth stocks. right? Like that is the trade that is just that you had to own those. Because if you think about it, if you didn't own them, you were done. The reality is you're sitting there in your small cap, value stocks, and while everything else was screaming higher, you're out of a job. So the reality is no one was left. So one of the things that I like to think about in terms of is this move going to get bigger or larger? And although we might see, a little bit of a correction, as you say, if we get a disinflationary impulse, over the long run, I think it's headed much, much higher.
But that's the cycles. That's the cycles. Like,
right. But if you think about, like, if you're taking money out of Google and then you're sticking it into small cap, or even not even small cap, you're to go look at all these things that people are.
By the way, Google is at its near its 52-week high.
Google's not the right word. Tesla. If you're taking money out of Tesla, and you're putting it into small cap, then you're moving those a lot more, and that's the point. And I think that those stocks, those like the XLFs and energy, they're all underowned. And what's overowned is all those big cap tech stocks. And so, although I've been sitting here thinking about maybe the leadership will continue, there's no doubt in my mind that if you said 5 years from now what's going to be up, it's going to be those other value names, and what'll be down is those tech stocks. One of the interesting things that I think about, Patrick, is that when I used to tell people this, and I used to say, "Oh, we're going to see a correction in all the FANGs or all those big, the top 7 names." Everyone said if that happens, the indexes are going to get destroyed. There's no way that we're going to be able to have this rotation without a huge calamity in the stock market. And yet I'm looking at this, it's going on, and S&P's kind of treading water. Yeah. Right? Yeah. And it's not, and like, as you say, you go look at the small caps are near the highs.
Yep, it is. But let's go through some of these sectors. Okay, so we already put up the financials. Here's your favorite, your little regional banks. Still up near 52-week highs and beautiful trend. What's actually interesting, I want to quickly show. What's interesting is the consumer discretionary names did take it pretty heavily. I mean, from top to bottom, over $20 off their highs. But what's interesting is the consumer staples are suddenly turning up a little bit. And so it's interesting that where the correction. So the consumer cyclicals definitely have been taking it on the chin with the technology names. What's also interesting is we've seen a pretty distinct correction in this healthcare space. Now, healthcare has been correcting for almost well over a month for sure, like 6 plus weeks. But what's interesting is some of the components in there, like the Pfizers and Mercks and a number of these names have just been murdered to the downside, even in the biotech space. And what's interesting is will we see these these bond proxy sectors, the staples, the healthcare, a lot of the telecom names, the REITs, they've all been obviously getting hammered because of the bond proxy kind of element to them. And question is that if you're sort of think that the bond move has played its course, I mean, is this a buy on dip on all of these bond proxy names?
I don't know, Patrick. I don't know. And one of the things is
I think it's worth watching.
Of course, but like one of the things that I will tell you is that I'm a big believer that rates are going a lot higher over the longer term. So whether you should be wasting your time
we're traders. I'm not talking about a long-term position in these things. I'm talking about for a cycle turn here.
I feel like you'd be better off owning the financials, don't you think?
Well, there's no dip to be bought in the financials. You're chasing at this moment. I mean, they're at 52-week highs, right?
They still feel underowned to me. They still feel underowned, and nobody likes them.
Well, sure. I mean, they're not. They're barely scratching their 2020 highs, right? Yeah. Like the other sectors, like the autos and other stuff, have already had these ridiculous runs, right?
I guess that's just my point. In terms of the dividend proxy names, I'd rather own the financials than those.
And what's interesting as well, it's worth noting, I'm just going to use the JETS index, which is the airlines, but whether you were talking casino stocks, whether you're talking airlines, whether you're talking any of these recovery stories, hotels, all of them, the cruise ship stocks, they've all had a pretty epic February month based upon a lot of these stories that are hitting the media about the fact that there's going to be an epic resurgence once the vaccine's administered and people feel free from this lockdown. And they all have really had a good run. And we've seen a correction in the last few days. I'm one of the curious things I'm watching is whether this is a buy on dip for a continuation in this little trend. Do you have an opinion on those?
Well, so first of all, here's one opinion. I think that there's not been enough attention given to the fact that the rollout of the vaccine basically was increased by 2 months. Like the timeline, in terms of getting the vaccine to Americans was brought forward 2 months. And I think that was also part of the bond sell-off, is that you saw, this ability for the economy to grow because we're going to get vaccines at a faster rate than was previously expected. And I think that is the growth is seen more. And in terms of these stocks, I'm not as bullish on them in terms of buying the actual stocks. Like I believe their economic activity will go up. I think the people will be booking them. But my suspicion is that there's going to be a lot of that price already discounted. And let's face it, these guys have been issuing a lot of stock. Like you go look at how much the cruise lines have issued. Yeah. The dilution is huge. And so one of the things that you need to be careful about is if you look at some of these stocks, you might say, look, it still could go up to the old highs. But the one thing you have to realize is that the market cap of those names is actually much, much like higher than it looks because they've issued so much stock. It's kind of like a Vancouver penny stock Vancouver penny stock that doubles its float. When they do some monster issue, it ends up being a lot more difficult to push it up later. So that to me is the one caveat I have about chasing those names.
Right. So I want to leave everyone with one chart. Kuppy was talking about it, the Russian ruble. How can we not show the chart on this thing? And the one particular part that I liked about Kuppy's idea is that one thing that you can always see with the ruble is a correlation to oil. And oil's been running, and the ruble has not yet reacted to it in the last 4 or 5 months. And I'm curious whether this big push in oil will finally cause the Russian ruble to have a breakout. And so anyway, I just wanted to point out, because since Kuppy's buying it, I thought it was a chart worth mentioning.
It's just like Kuppy to be buying something that's just, he can't just go stick it in T-bills, can he?
What? That would be foolish. All right, but that's all I got.
Okay, so it's time for This Week in Trading History. What do you have planned for us on this venue?
Yeah, whenever we talk history, I always like to go farther back in history and kind of really poke deeper. But you know what?
Well, you know what? I know why you do that, though.
Why?
It's because people don't remember it, so therefore they don't know when you're wrong. So when you do this one and you're going to do something and people are going to go, that's not right. And they're going to realize that you're just
that I'm making shit up. Fair enough.
So they're like, so this little,
I'm just a storyteller, Kev. I'm just a storyteller.
Okay. So what story do you have for us?
No, but I thought it was worth circling back to the IPO of Palm. Right. And so we're going back to March 2nd of 2000 when the shares of Palm Inc. started trading on the NASDAQ. The initial, IPO thing was priced at $38 after they were spun off from 3Com Corp. And what's interesting is that, and what's very relevant about this IPO is that it was IPO during the peak mania of the bubble, because the ultimate NASDAQ top came in on March 24th. Just 3 weeks later. So this is sort of that kind of IPO that comes in right at the blow off when the froth is the thickest and everyone wants a piece of the action. And it just feels so relevant talking about it because we see so much of that today, right?
Oh, this is exactly like it's kind of all, this is actually even worse than anything we saw today.
Oh,
because
no, Palm isn't worse. You're talking today is worse.
No, I think Palm's worse. I think this is
all right. Okay.
Like, I think we could still get worse
All
in
right.
terms of
So
the current market?
let's talk about this. So the shares after it started traded that day as high as $165. So it went threefold higher, and but ended up closing the day around $95, giving Palm a market value of $53 billion, which doesn't sound like a lot today when we have Tesla at $900 billion, but recognize back then there was no such thing as a $500 billion cap stock or anything crazy like that. To put it in context, it was larger on its IPO than both General Motors and McDonald's. And it was also larger than its parent company, the 3Com, which was valued at the time around $28 billion. This is where I thought you'd be interested, because that IPO created a very strange pricing arbitrage between the parent company 3Com and Palm, because 3Com retained 500 plus million shares of Palm, or about roughly 1.5 shares of Palm for every 1 share of 3Com. So, and since Palm stock closed at around $95 on that day, that should have valued 3Com's worth about $142 a share, even though the stock was only trading at $81. Right. And so it was basically mispricing, theoretically, 3Com's market cap by $60 a share, some minus $23 billion differential between the two. So Lehman Brothers highlighted that the pricing anomaly and was saying that theoretically 3Com should have been trading around $170 a share when it was only down at 81. Based upon this. And so it's amazing that Wall Street creates what might have been the most worthless company of all time at the moment. This attracted, though, attention of people such as Kuppy and yourself, the arbitrage-minded investors that are many sought to exploit this big differential in the market capitalization between the two. Obviously, the idea is that you would go and you would buy 3Com and short Palm. And you would play eventually this converging back to its fair value, sort of the way people are messing around with the Mister today against Bitcoin and other things like this. But the obstacle, of course, was putting on the spread, because of you had to borrow Palm stock. And as an IPO, it's actually hard to locate very large borrow. You can't easily short sell the stuff. And that was actually the biggest obstacle back then. But of course, like most bubbles, this one blew off in the end. And in the end, Palm would be sold to Hewlett Packard for $1.2 billion or $5 a share in 2010. It always ends the same way, doesn't it, Kev?
Yeah, you're absolutely right. Now, we call this the stub trade, meaning that like when you buy a company and short the other, and then what you get for the rest of the company. So this is probably the ultimate in stub trades. Very rarely do you get a situation where you can buy one company, short its value, in terms of what it owns, in another publicly traded company, and then get yourself actually a credit. And what you're implying here is that it was trading at below the price of what Palm was worth to, 3M, right?
Yeah.
Right?
No, 3Com.
3Com, sorry, I got it wrong. And so one of the things that you need to realize, though, is that this is kind of probably artificial, because they hadn't floated a lot of the shares.
Yeah.
So this is like what you see, like when we have a Tilray situation where they go and they just float 10% of the shares, or even, Nikola was the same way. They float so little of the shares that it ends up being that, that price of where that IPO or that very, that company is going to trade is eventually going to go down. The trouble is you just can't afford to hang on, until those shares come out.
Yeah.
I think a better example of this, Patrick, was the Bell Nortel situation. Because Bell Nortel, the same thing happened. Bell Canada owned, a whole bunch of stock in Nortel. And as Nortel rallied, because it was a real sexy telecom stock, it eventually got to the point where you could buy Bell, short Nortel, and get a credit, just like in this case. The thing that was different about the Bell Nortel spread was that there was lots of Nortel to short, and it was already fully diluted out in the marketplace. So one of the problems with this is it's a great story, and obviously if you were able to come up with the borrow, you made yourself a fortune, but there was actually it was more difficult to actually execute that trade. Yeah. And some of the other ones that have occurred over, the history have been almost better because you could do it in bigger size.
And the other, another side note on Palm is that back then when this launched, everyone was so sure that Palm Pilot was the future, and these handhelds, and in the end, to one degree or another, it was. But it was then BlackBerry and then Apple that came along with devices that basically became more superior to Palm. And so while a lot of people love to initially buy something on a concept phase, it doesn't mean that company is or coin or anything else is going to be the end winner down the road. And Palm is a perfect example of that. Like, they really had the right idea, but they weren't the winner at the end of the race, right?
They were 10 years too early. And it just shows you how brutal capitalism is. You're absolutely right, Patrick. That was there for all intents and purposes. We should all have Palm Pilots in our pocket, but instead we have apples.
Yeah, and that's the way it is. All right, Kev, I'm done talking charts, so it's time for skin in the game, and I got clipped. I got clipped. This is the most dangerous thing is that what you do is it was instead of coming up with the bet before, you were listening to where you seen that I was kind of cornering myself, and then you're like, I'm going to find something to exploit this piece of shit for, and you got me. Congratulations! I already got the Christina Maria wine for you, or whatever, Maria Christina.
Oh, you mean wine. The box wine?
I got it for you already. It's
is it got
it's
like
already gift wrapped?
It's so sweet. It's going to give me like I'll have a headache immediately.
Yes.
I'll just put it in the freezer to make sure. So why don't you tell people the bet?
Well, we bet on junk bonds on HYG. It was a one touch, and you know what? I mean, the level you picked was. Now after when I realized I had one too many beers, I was like, what the hell did I get myself into for a 1 week deviation to hit that level? But hey, you got me. Congratulations. It was whether or not it was a one touch at 85.11. It did sell off this week, but
you were right.
Realistic.
Like, listen, let's face it. You were right. You just got the magnitude wrong. And one of the things that
I didn't get the magnitude wrong. You're the one who was making up the hits. I was just too much of a sucker to want to take the other side of it.
You were too keen. One of the things that I looked at this and I realized, like, everyone gets excited because they look at the chart in the COVID crisis, but that was, credit was blowing out. So first of all, most of the decline in the COVID period was from credit and not from duration.
Right.
And I looked at it and I said, credit's not going to blow out that much. And then a lot of people or overestimate how much duration risk there is. This thing's like a 4.5 year duration. It barely moves. So it's all credit. And so I just kind of realized that you were probably a little too eager.
You got me. And so you won. You get your wine. I find it didn't get you a box wine. You can get whatever bottle you want, whatever.
Okay. I'm going to keep it for the Market Huddle piss up. Maybe I won't. No, you know what?
No, you got
the Market Huddle piss up should only be beer. Yeah, only beer.
We'll settle up the wine and steak is set up between
separately. Okay. So let me tell everyone about the game. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows. A Duke and Duke, which is a crisp $1 American dollar bill. A pint of beer, a burger bet. A pitcher, a case of beer, 2-4. A bottle of wine, which is actually the second highest. That's how keen you were about it. The second highest bet. This is our first wine bet, right? Like, that was our first
No. We had another wine bet.
Oh, did we?
Yeah.
And did I win that one?
I don't remember now.
Lena, so I might have two bottles coming. Steak dinner, which we still have not done. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions.
All right, Kev.
So, listen, I got to come up with one, and it's got to be crude oil.
Okay.
because you're too excited. So what do we do? Let's just make sure because crude.
Now we're going to start with the April contract. Okay,
I was going to say what contract will the April be the lead contract for the rest of the next week?
Yeah.
Okay. So I was tempted to say, you know what, I'm going to go and I'm going to give him a higher level because he's going to be bearish or something, and I was going to do that. But I've decided that instead I'm going to go on the downside. And I'm going to go and I'm going to say one touch on the April contract. That's the J, right?
Yeah, this is the, yeah.
Yeah, so I'm going to say one touch, 57.77.
57.77, one touch in 1 week.
Yeah.
I'll take the above.
Okay.
I'll take that for 1 week. Okay. All right. So 57.77, did you say?
Yeah.
Okay. 57. Lena, write that down. 57.77. And what are we going to do?
I'm not big. Let's just do a pint of beer so the Mark Huddle piss up has more beer.
No. I think the piss up means pitcher.
Oh, sorry, a pitcher. Sorry, that's fine. I'm good with the pitcher. Yeah, that's what I meant.
Okay,
because a lot of pitchers going.
Yeah, we'll okay. I'm good with getting members.
I'm going to lose, but that's fine.
You know what? I thought
one touches though are kind of sneaky.
Yeah, it's a little sneaky. I mean, it can happen, but not in a week. I think you sold your. Oh well, who knows? I'm not going to gooch on myself. No, it's done. It's done. All right. You're just being nice because you feel bad for picking me off last week.
Gotta let you win one. No.
It's a sympathy one. It's a give.
It's like a sympathy. I know what you were about to say. That's fine. Okay, let's go on. There it is. There's Ernie. Okay. What's the next?
No stupid questions. All right, Lena, hop on.
Lena, save us.
Save us, yeah.
All right. So the first question of the week. Hello from just across the border, Buffalo. I am a relatively young trader, just graduated this past May, but have been trading stocks and options for the last 5 years. Over the past year or so, I've grown rather familiar with trading different trends in bond yields since I have found I'm a bit better at the macro side of things. This results in me spending more time watching the TLT and 30-year rates than I'd like to admit. While I have always known the TLT includes the 20-year bonds, I've always neglected them and mostly watched the 30-year until just about 20 minutes ago when I decided to take a peek at them and ultimately triggered me to question everything I know. While I understand yield curves can cross based on economic outlook, it appears the 20-year yield has never, at least according to Koifin, traded below the 30-year. From my understanding, shorter maturity dates also have lower yields, given the less interest rate risk to their longer-dated counterparts. So why is this? I'm ready for the email address to be proven wrong and that there are, in fact, stupid questions like this one. Thank you guys for supplying this great podcast. Been listening since the beginning. Now time for the important part of my email. I don't ever recall loose powels as a symptom of too much market huddle, so I figured I'd throw it over to you guys in case you were running out.
I like that. Loose powels. That'll have to go on the list. Okay, so great questions. First of all, you should never feel bad about watching 20 and 30-year rates more than you care to admit. Right? Let's face it.
Yeah.
I love watching rates. I love watching it. And this is actually a great question in that, I was thinking about it. I was like, there's no way the 20-year, was never inverted versus the 30. I immediately thought to myself, no way at all. So I pulled it up in my Bloomberg and I'm like, what the hell? Why is my chart only going back a year? And that's probably, I'm assuming, what's happening with the Koifin as well. And the reality is that the Department of Treasury, the entity that's in charge of issuing bonds, they stopped issuing the 20-year in 1986. And it wasn't until last year in May that they reintroduced the bond. So although technically there was a 30-year bond that they issued that, 10 years later, you could have traded that as a 20-year, quote unquote, there was no official auctions and official 20-year bond. So therefore, when you're looking at the data, be careful because you're probably not looking at data that is complete all the way back. And it probably doesn't have 1986 been before. So I did have a check, and yes, indeed, the 20-30 spread has inverted lots of times, and so you are correct. The problem is that you just have mistakenly not realized that the 20-year data does not go back as nearly as far as you wanted to know. So I had no clue, because I actually thought Bloomberg extrapolated out a 20 from the other bonds, and I was actually shocked to find out that if you don't have an issue, that like an auction for that bond, the Bloomberg, and I'm assuming Koyfin doesn't do it either. Anyway, so I learned something too. Thank you for the question.
Yeah, and so perfect, Lena. What's the next
Second question. Hi, guys. Thank you for a great show. I've been watching it from day one and need to say I've learned a lot. My question is related to the terms you mentioned a few times, gamma pin and gamma flip. I was trying to Google, but had no luck, so please explain if possible. Thanks again.
All right. Well, this is, first of all, just the gamma pin is and gamma flip is all about dealer positioning. So dealers are taking the other side of the trades, and they're basically in the end holding inventory of options. And it's the nature of how their option position typically looks. And dealers wanting to always be hedged are going to be buying or selling a certain amount of futures in order to stay neutral. And one of I think before, without us trying to answer during this period, what I think we just want to do is encourage anyone who wants to learn about this in greater detail to circle back to the number of great interviews that we had with Brent Kachuba over at Spot Gamma. And the one episode where we actually went into great detail with him on this was his first interview, episode 63. I can't believe it's been like 60 episodes ago. My God. But it was the January 17th of 2020 where we had Brent on, and we went into great detail with him about explaining why and how this gamma works and how these terms are. And so I encourage everyone that wants to learn more about that to circle back and hey, Kev, we're going to get Brent back on the show
that's right.
soon. Anyway,
he's scheduled for next week. We tried to book him so that he's right in front of a quarterly expiry. He can give us all the readings about the dark arts about how all this is setting up. And it's becoming more and more important. You know, when this started, I don't know how long it's been, but it used to be that nobody cared about it. But now everyone, given that this is affecting the markets in such big ways, everyone's interested in it. And we look forward to having Brent next week.
All right. And so, Lena, what's our last question for the
last question of the week? Hey, team, I love the podcast. It makes me laugh, educates me, and gives me hope that if you guys can carve out a career in financial markets, maybe I can too.
Okay, stop, Lena. Is that a compliment or is that an insult?
But that's awesome. It might. I don't care what it is, but it's awesome. That's all I can say.
Okay.
If you guys can make it, there's hope for all of us. Yeah. All right, go for it.
My question is, when you feel good about a theme or hypothesis and want to play it through individual equities, how much due diligence and research do you do into any equities before buying? I.e., do you assess the management team, the corporate structure, compensation, listen to previous earning calls, etc.? It seems like the rabbit hole is infinitely deep, so you have to stop somewhere. What do each of you check? Do you have a process, or do you just YOLO and assume the market is doing a good job of evaluating most of those things?
All right. Well, Kev, can I start?
Yeah, go ahead.
Right. Well, listen, the one thing I'll first point out, and I think that, Kev, me and you have this conversation all the time, is that what's amazing about the markets is everyone gets from the markets what they're looking for. So there's an infinite number of ways to approach the markets. If you're like a value manager or you're basing on the fundamental research, technical research, there's different approaches. Now, this question specifically is how do we do it? I use an approach of shoot first and then research after sometimes. And a lot of times when you see something is setting up, because I use a top-down macro approach of kind of trying to understand the way the markets are setting up in the bigger picture, and then I kind of work my way down to where I think the opportunities are. Often, the most important thing when I get in is how can I manage the risk? How can I size the position? Is it a good place where the asymmetry is in my favor? And sometimes that is more important at the start than as to whether or not you've done all of the due diligence and homework backwards, because you can always exit a position. And I think that is a lot to do with my size, in a sense that I'm not whipping around Stanley Druckenmiller style portfolio sizes. When any trader that even has a couple $1 million is able to enter in and out of the market without anyone noticing that they were there. And so I think as a smaller trader, you really can have a lot more flexibility in this. I think where the due diligence is all, if you're a fiduciary or if you're doing long-term investing or your style, a lot of those things are far more dependent. What's your take on that?
Patrick, I'm going to call you Ready, Fire, Aim from now on.
Okay, there you go. Perfect.
Ready, fire, aim. That's Pat. No, listen, I completely agree. And I would argue that the bigger the stock, the less due diligence, or like absolutely zero due diligence, I'm going to do. Like the reality is that I won't stop and think about looking at the fundamentals for, something that's like, Freeport or Tesla or something. There's so many analysts doing so many things that I'm not interested in trying to come up with some sort of research process where I'm going to figure something out. There's
no alpha in that.
There's no alpha for me in that. So I would argue that the bigger the stock, the less that I will do. Now, having said that, I do trade littler stocks, and I don't talk about them at all. But I do have positions in those, and I will do a little bit more on those. I don't like actually talking to management teams. I've always said that the reality is I'm not smart enough to not be fooled by a good good story or a good person, like somebody who can really tell a story. So one of the things that I refuse to do is I don't talk to management. And I remember reading about some research guy or some analyst that he said that everything's there in black and white if you want to see it on the actual disclosures. So and I agree with that because you don't want to be susceptible to those human failings that you have where you might like the person or that person might be more charismatic. Having said that, Patrick's alluded to it, and he's completely right. There's, this is the style that works for us. But I know fellows that work at hedge funds that are true value, people, and they will go and they will phone the management. They will phone the customers. They will go and see the stuff. They will do everything, and they will know that stock and that company better than the people that are working there. And so it really comes down to a style, and as Patrick says, where you think your alpha is. If you think your alpha is picking, a macro trend and then trying to figure out somebody that's going to benefit from that, then it's probably not worth it to sit around and worry too much about, talking to management. And one of the ways that I get around that as well, in terms of eliminating some of the risk of, individual management being bad or individual companies being bad, is I'll buy a basket. So let's say that I'm bullish uranium and I don't really know and don't want to spend the time trying to pick the uranium stocks, or I don't even think that I have any edge there. I'll just buy a basket of uranium stocks and I won't worry about it. Or I'll just buy the biggest one and go, yeah, you know what? It might not have the most torque, but at least I know there's going to be less chance of a real surprise there. So that's it. So I guess you just have to decide what you want to do and where you think you can add or where you can find your alpha.
I couldn't agree more. Lena, can you just share with everyone where they can submit their questions?
Sure. So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Because there are no stupid questions, only
stupid answers.
That's right. Okay.
So that's it for the show. Now, before Patrick, I want to do a little rant.
Oh, yeah.
I got my rant to do. Okay. So I've actually I want to take some time here. And so lately it's come to my attention that I've made some people in the crypto community upset. Shocking, eh, Patrick?
I would never have thought.
So now I want to I got a few points here I want to make. So I want to make sure I don't miss anything. So I tried to explain to these people that we make fun of everything. Patrick makes fun of my inflation calls. He jokes that I'm like that kid in Sixth Sense where I see, instead of seeing dead people everywhere, I see inflation everywhere. I make fun of his call for 0% long bonds, and we like to have fun. Our show is about drinking beer, talking markets, and enjoying ourselves. And then we hope that you might learn something along the way, okay? At the end of the day, we're fortunate to live in a free society where we can have differing opinions and we can trade with one another, okay? And I try to stress that if we all agreed, then there would be no one to trade with, as we would never have anyone on the other side of our trade, right? There'd never be anyone to trade with because we'd all belong the same things and we would all have the same views. Okay, but this sort of talk, when I try to explain this, seems to be lost on the crypto community. They've accused me of being short, meaning short Bitcoin, or bitter that I missed the greatest bull market of our lifetimes. So I just want to clear some things up. I am not short Bitcoin, nor have I ever been short Bitcoin. Let's say with you, right, Patrick?
I'm not, no.
Yeah. Not even a little tag in for me. And in fact, in the interest of full disclosure, I'm actually long Bitcoin through my Bitcoin ETF, BTCC.B, which is the Canadian ETF, and versus I'm short MicroStrategy, the stock, okay?
You didn't cover that yet?
No, I covered a little bit today. Anyways, okay. I was going through, and on October 19th, I actually went in my letter and recommended getting long. Not recommend, I don't recommend anyone. I tell them what I was doing, and I was getting long Bitcoin for a trade. And yes, I couldn't hang on nearly long enough, but it's not like I've been taking stabs at the short side for the past 2 years, and I'm a frustrated bear, okay? I try to make fun of myself and say that not only have I missed Bitcoin, but I'm the idiot who mined it and arbed it at $50. $50. That's how dumb I was, okay? But I wasn't smart enough to put aside 50 or 100 coins back then. Like, I could have done it. It would have been a no-brainer, but I'm an idiot. I didn't do it, okay? Yet my humility doesn't seem to appease them. I like offer this up, that I'm this idiot. It still doesn't seem to appease them. They then accuse me of being bitter that I missed it, Patrick, okay?
But you are bitter, or is that just your age?
They imply my regret is driving me green with envy. Okay, listen. I regret a lot of things in my life. I regret all the times I was unkind to someone who didn't deserve it. I regret all the times I was too scared to stand up for someone weaker than me. I deeply regret that time in second year of university when I was at a bar and a 30-year-old hit on me and I thought she was too old. Okay? But I don't think about missing Bitcoin more than any other trade. And there have been so many great trades that I've missed over my decades of trading. So if I actually stopped and worried about everyone I missed, I would drive myself mad. So do I wish I had bought Bitcoin at $50? For sure. Does it influence my behavior? Not a chance. And I guess that's the part that I didn't understand with my joking. For me, these are all just trades.
Yeah.
But yet it seems like for many in the crypto community, it's much more than that. Therefore, what I think are jokes and taken as good-natured fun end up being deeply insulting to them. So, I apologize if my jokes have offended you. They weren't done with any ill will. I guess I just didn't appreciate it, that it was just a trade that for me, but for you guys, it was much more. Now, the other day, I tweeted out a picture with the tagline, "Here's to all the people with different opinions, and we can still be friends because we're adults." And I guess that's the concept I was going for, Patrick. Yeah. You and I are diametrically opposed on many of our market views. Yet I couldn't ask for a better partner. You shit all over my positions, and then we go out drinking together. Okay? This is just markets. It's not something serious like when a child gets cancer. My or Patrick's views about the US dollar, or any other asset for that matter, is inconsequential in the grand scheme of life. So when I was tweeting out that we can have different opinions and still be friends, I was shocked with the reply that I got. I got, "Yes, we completely agree, except for that BSV guy you had on." That's not how this works. Many of you guys in the crypto community are upset that we gave that guy a voice and I didn't grill him. Well, if you want to show where we grill guests, then this isn't the place for you. There's been a lot of guests whose hard money policies I believe would cause real economic hardships. I fundamentally disagree with their views. Yet I help them tell their story. That's my job. And my job is not to vet and each guest and decide which story I want to hear. I want to learn. And Lord knows I've been wrong with many of my views. I get stuff wrong all the time. The greatest trader who ever lived, Stanley Druckenmiller, has a hit rate of 60%. That means that he gets stuff wrong 40% of the time. Well, if he's wrong 40%, I'm going to be wrong a lot more than that. And that's why we have different guests on, to learn. But Patrick, after thinking about it, it's clear that crypto is much like politics or religion. It's something to not be discussed at polite dinner parties. So I harbor no ill will for my crypto listeners. I hope you all win. But it's clear that it's something that many of you feel passionate about, and my sort of humor can cause offense. Therefore, Patrick and I have decided to have no more crypto guests on anymore. There are plenty of places for you to go to get that sort of information on that subject, so you don't need us adding anything. I won't ask any of our guests about crypto. If they bring it up like Kuppy did today, I will let them tell their story. But for Patrick and I, crypto will now be one of our 3 no-go zones: politics, religion, and crypto.
I have a fourth, but I won't say it.
So with that, it's going to be the last time we talk about crypto, and I just want to thank everyone for listening to my rant.
All right. I agree, Krav. We're in consensus. All right.
Okay, so thanks for tuning into the Market Huddle. We appreciate you all spending time with us. Please give us a follow at the Market Huddle. We're on Twitter every day. Give Lena a shout out. She gets tired of talking to Patrick and I. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our latest charts and visuals. And while you're there, please like and subscribe to get our latest content. Please like and review us on iTunes. We'd all appreciate it. And Patrick, where can they find you?
You can find me at Twitter at Patrick Ceresna, and you can follow me at bigpicturetrading.com, where there's a 14-day free trial available. And Kev, where can they find you?
Well, that's a new thing. Wow.
I had to add it.
Nice. I like it. You rolled off your tongue. You can follow me on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
All right. You know, at the timing of that show, Lena Hop On was perfect because I literally drank the last sip of this beer just as you were finishing the rant. You gave me enough time to actually finish the beer. So I'm like sitting there
ahead of me, and I was like, geez, how's he ahead of me? It's because I was too busy ranting about stuff.
Exactly. And I was, but it was a good opportunity for me to finish this one off.
Okay, so let's rate this bad boy.
Yeah. Lena, you go first.
Yeah, ladies first.
This was a little too sour for me. I knew it was going to be sour, but it was a little too sour for my preference. So this is going to be a 7.2 for me.
Oh, that's pretty high. What about you, Patrick?
You know what? After the first kick in the teeth, after I got like halfway through the can, it was... It actually kept tasting a little more. You get climatized.
You do.
I
agree.
And so once you get over the little shock factor at the beginning, and I started enjoying it. So I'm going to give it down the middle. I'm going to say 7.6.
7.6. Well, first of all, great can. Like It's got 12-year-old boy colors. First of all, like the green, and it's got the skull, and it makes you pucker.
Yeah.
And I must say, sticking it in the freezer
was the right call.
It's just, brilliant.
Ice cold sours make a lot of sense.
It really does. And this is my new thing I'm going to do is I'm going to stick them in the freezer because I actually enjoyed this. And I feel conflicted about this because I almost feel like I'm should
confused.
have another.
What the hell's going on here?
I know. I the world's changing.
You're turning my world upside down. This is like. This is like you going long the U.S. dollar or long bonds.
Yes, it is.
Like
it's
crazy. Like you liking a sour beer.
I know.
Like our listeners are going to be shocked.
I know. I'm trying to hang in with the millennials, or not even the millennials these days. The Gen what is
Zetters.
The Zeds.
Zeds
for the Americans. But okay, so I like this, and I'm conflicted about whether I should have like a whole other rating scale for sours. Because then you could say on a regular basis, because it's
from
not
1 to 5. We'll rate the sours 1 to 5, and the rest of the beers 5 to 10, because we don't ever go under 5 for most beers.
Well, anyways, I'm going to rate it the regular way, but we're going to have to talk about this. I'm giving it a 7.7. I'm giving it the highest rating of all three of us. I like it. I don't know though. I might have been fooled by the fact that it was so cold.
There you go.
It makes a big difference though. Actually, when I got it, it was a little bit like a Slurpee.
Oh.
Yeah.
Like it was actually like it's unfrozen now, but there was
That actually, you know what? A Slurpee beer
That
like this,
sounds
that would
good.
actually.
There we go. Is there
Like an
anything more
iceberg,
Canadian than a
right?
Slurpee beer?
No, that is, and maybe with a shot of vodka to give it the extra
Oh
kick.
God.
Oh my god.
Do you know that? You know where the
Or tequila.
Do you know where the
Tequila.
Slurpee capital of Canada is?
Winnipeg.
Yeah. It is. You guys think
It is.
You guys
Is
think
everything you
So,
drink
it's the
outside turns into
7-Elevens in
Slurpee?
Winnipeg,
Yeah.
man. Like there's lineups out the freaking
it's
door.
awesome?
For the Slurpee.
It's crazy because Winnipeg's so cold. You think that no way. But
Uh-uh.
like you Google it. How Canada's coldest cities became the Slurpee capital of the world. It's not just of Canada. I was
When was the
short
last time you
selling
guys
it.
had a Slurpee?
Oh, I don't drink Slurpees.
Well, I haven't drank a Slurpee since I was 17.
Well, yeah, in Winnipeg.
Yeah.
Like, there's like you once you left Winnipeg, you left the Slurpees behind.
It's true. Although, you know what's be funny? For a little while, I had a roommate, and it was a guy on the convertible desk, and he was from Vancouver. And Vancouver, they're not as into Slurpees as much as Winnipeggers, but they're still into Slurpees. It must be a West Coast thing.
Yeah.
And we literally one day were like, we need Slurpees, and we were sitting there. We're like 27 years old or whatever. Got in the car, and we had to drive far for a Slurpee because there's not a lot of 7-Elevens in Toronto. But we found one, and we went and got a Slurpee. Wasn't as good as we'd remembered, but it was still fun to do nonetheless.
What flavor?
Oh, well, my favorite by far is watermelon.
Ooh, me too.
Oh, really? Oh,
Yeah,
nice.
watermelon, or it would have to be watermelon or grape.
Oh, see, I don't like the grape
See,
as much.
I'm biased by color. Like so, like whenever I've done it, I've always done like the multi layers.
Oh,
So like
You're
you
one of
go
those
like you do like an
people.
inch and a half of like each one. And you have like 5 or 6 different flavors in there, and then after a while, I don't know which flavor I'm trying. Like all I know is it looks
fruit
really cool.
punch.
Yeah.
It just looks cool with all the different.
So what do you
layers.
call it? Like when you went to a pop machine when you were like 7?
Swamp water.
Oh, good. Yeah, swamp water.
It's swamp water.
Yeah.
Yeah, where you take some of every pot.
Yeah. So Lena,
Yeah,
what
like
do you
I mean,
call
listen,
it?
we played hockey. Like that's what you did. You went into the hockey rink as a 10-year-old. You played a hour of hockey and went for a swamp water.
Yeah.
I think that's like strictly a boys thing. I never did that.
Well, you know what's funny? Because I told my wife that, and she was like, "What? Nobody calls it swamp water." I was like, "Everyone calls it swamp water." So Patrick,
I've never heard that term before.
yeah.
Oh,
I don't know. Maybe
Oh,
it's a
that's-
Canadian hockey thing then.
yeah, it is.
Yeah, probably.
Because like
It's a hockey rink.
you
thing.
didn't even
Clearly, I
hesitate.
don't
You
play
were just
hockey.
like swamp water. I was like, yeah,
I
of
knew
course.
exactly where you were going before you even said what it was. I was like, yeah, no, I know where you're going. It's swamp water.
It's disgusting, but it was. That's what
Oh,
it's
it
called.
was good.
Oh, come
I think I think pop is disgusting in general. So like, does it make it more disgusting when you mix it all together?
Pop should only be a conduit for your scotch,
What?
or not your
I
scotch,
don't
your rum or whatever you. mix.
No, I drink everything neat.
Oh,
I
nice.
don't even mix. I don't mix nothing.
That's true. Actually,
Yeah,
when-
you should have seen that. You saw that video of me at Kuppy's birthday. Like that's the way I drink my rum.
Oh my god.
Ugh. You
I
gu-
wish I could include that video in here, but we're not going to.
You guys were barely able to use your hands.
Oh, it was a disaster.
He was barely able to stand.
Well, when you're standing on a chair, it makes it hard. Okay, I'm gonna shut up. So it was.
Was it a good time? Was it a nice restaurant? Where did you go?
He doesn't
Oh,
remember.
No, because that was the second night. So like the first night it was Kuppy's birthday, and that was just a shit show. I don't remember too much. And
But the second night, where did you go?
But the second day, I went for a tour of South Beach. We went checking out real estate and all shit like that, and then we went to what's it called? Prime something, Prime Fish, I know it was one of these South Beach restaurants, and it was a pretty epic.
Prime Fish,
porterhouse.
Miles Restaurant Group.
Yeah, that's probably
Actually,
it.
I think that's it. I've seen Kuppy. He sends me pictures. Like he must have lived there. Because like
oh yeah, that's his watering one of his many
Because
watering.
like I can
holes,
recognize the place already from all his his 11:30 at night drunken tweets that he not tweets texts that he sends me.
Oh, but it was a really good steak. It was good. His wife is awesome.
Oh yeah.
She's so nice. I don't know how he scored her. That's
Somebody should talk to her. No, you could do better than this asshole. He'd appreciate that. He'd probably be the first one to tell you. So what did you get? Did you just get like a tenderloin or what? A strip loin? What did you do?
No. We got the porterhouse. Buddy.
Oh,
talking 48 ounces.
Nice.
Like he went for the most expensive steak on the menu.
He didn't let you off the hook.
Oh no way! Like, and why should he?
Yeah.
Why should listen? When we throw a steak in this huddle bet, we're going wagyu, dude. We're like these steak bets are so goddamn rare that in terms of the frequency we do this, why the hell would you go to the like a Ponderosa and get yourself like a strip steak, right? Like we're
go big or go home.
Like at this stage, one of us is going to tax the shit out of the other when one of these bets goes when we finally put this on the table.
So you're a
I
prime.
feel like I have the meat sweats just.
The meat sweats. It's been a while since I've had the meat sweats from eating a 48-ounce porterhouse. I'm jealous.
Oh my God. Yeah.
Oh, this is out there. Like this is. Oh, I see where you were. You were right at the peak there. So Patrick,
Yeah.
I should have told you to go. I'm kind of obsessed with this place called Hallover. Is it Hallover? Hallover's Inlet, and it's this inlet where like all the rich dudes bring their boats out and get out to the ocean.
Right.
And some idiots don't know how to drive a boat. and listen, it's like got the swell comes up there and stuff, and it's just awesome. Like I sit there and watch hours of videos. Well, it probably is hours to be honest. Of hours of videos of guys in big, huge, $500,000 boats burying the nose. It's awesome. It's so much fun to watch. Like it is great. And then what I love is like the old, disheveled guy in like a little dinghy comes and just eats it up because he's like, been in the Miami area forever. He drives his boat. He just kind of zips through and everyone else is getting chewed up.
Yeah.
Anyway, so you should go next time, especially if it's a rough day. Go to Hallover's Inlet and just watch the boats.
All right. I'll do it.
Well, there you go. Lena,
I'll do it.
Dog update.
Yeah.
This is the big week, right? Like this will be our last week talking about it.
They got their first shots this week, and one of them will be definitely going to their permanent home tomorrow.
Okay, and so which dog is it?
We don't know yet.
Oh, you still haven't decided.
It's undecided, so I'm kind of.
Are you guys
torn
the
right
ones
now.
picking, or are they? You're gonna let them pick one out?
They're gonna pick one out. They're friends of ours, and so we
Is
already
that
know-
Miro?
Yes.
Right.
So they're gonna pick one, and they're gonna go home with the puppy tomorrow.
Wow.
So
are you a little sad?
a little bit, yeah. They've been so cute, and like I feel like Cinderella every morning. I go downstairs, and then they all greet me, and now it's just to think about one of them's not gonna be there. It's kind of.
Oh,
it's a
are you gonna
bittersweet-
cry? No.
It's a bittersweet kind of feeling, but I know they're going. They're going to a good home. So,
Okay.
Yeah. So I'm happy.
Oh, but you'll
about
get
it,
to
yeah.
get to see them.
That's the nice
they're your
thing,
friends.
right?
Exactly.
Like, yeah, you're going all to
Exactly.
friends.
Yeah. So it's good.
And
Just
which
that
one
I,
are you?
I guess I've grown attached to them.
And are you any closer to which one you're picking?
No, not yet.
Oh, Lena, you're just gonna
If
keep us
we
guessing.
could-
You
I
know
would
what?
love to
I'll
keep
I'll
them
tell
all,
you
but I
only
know
what
I'm
I
not
would do
going
in
to.
that scenario. I would take the runt of the litter of like.
Oh, yeah.
Well, that's
first
kind
let
of what we
everyone
were
else pick,
thinking.
and make sure the one that is left behind gets the love.
Yeah, that's kind of what we were thinking because they're all so cute. They're
That's 'cause-
all so cute.
Because Patrick was the run to the litter. That's
Yeah, no shit, eh? Nobody loved me.
Listen, if anyone there's a run to the litter, it's me. My brother is 6'4", and I'm like this.
Your brother was on won a Stanley Cup with Colorado, dude.
But he's tall. That's my point. And my dad's
you
tall
are the
too.
runt of the litter.
I am the runt of the litter. I'm this little guy, and my dad's tall too.
You're not little. It just so happens that everyone else is big.
Do you know what's funny? I'm not little. You're just big. That's what I'm gonna say. You know what's funny? Obviously, I grew up with a very good athlete in my house, and I always thought I thought I was a terrible athlete. And so I'd go to places and I'd be like, say, do you want to play this game? I go, I can play, but I'm not very good. And then I would play and I go, I thought I wasn't very good. You're atrocious. And the reason is I realized I was comparing myself to somebody who ended up being a professional athlete.
Yeah.
So my whole life, I kind of felt like I was this terrible athlete, but the reality is that, you know, he was just that much better than me. So a little heads up. But anyways, I am the run of the litter, so it's not you, Patrick. It's me.
Oh, there you go.
Yeah.
It's I don't know.
Okay. Anyways, everyone have a great weekend.
Yeah. Yeah. Have a great weekend, everyone. So we'll and to be continued next week. Good luck on your bet. I wish you the worst of luck, but
you too, bud. See you later.
all right.
Lena, you know what? I wish you luck with giving away your dogs. Not luck, but obviously, I hope it goes well. But as Patrick pointed out, they're going to a good home, and you'll see them again.
Yeah, exactly.
Okay.
All right.
Take care.
Take care,
Have a good
everyone.
weekend.